sir on the dais. Let's welcome with a big round of applause. Friends, we at WRC, through various programs, empowering our members through knowledge sharing, through updation, and we are the part of the profession where update is at most required. And this DTRC event, I hope you will have all the updates related to the topic of direct tax. Friends, as you know that we are heading towards our legacy year, that is 75th year by 1st of July, and we have planned a grand celebration. So I request each one of you, on 1st July, we have flag hosting by 9 a.m. at ICI, and from 10 a.m. to 1 p.m. we have singing competition at ICI at our VKC, and then we have cultural night at Thakur Auditorium, Thakur Village, Kandivali East. That will be a power pack celebration for the legacy year. So I request each one of you, please be part of that and kindly fill the Google form which we have shared on mail so we can understand the number of presents. With that, now I request Murtaza Bhai to introduce the faculty of the session with his address.
Thank you, Saurabh. Good afternoon to all. So I have been on this DTRC twice earlier, so let me get straight to the introduction. Anish Bhai is really a very dear friend. Anish Bhai, welcome and thank you for accepting our invitation. And he's done tremendous amount of work, not only at WIRC, but also at Bombay Chartered Accountants Society, and he is regularly a speaker, panelist, moderator, and whatever support we want, he is always ready. So with that, let me go to the formal introduction. Fellow member of the Institute of Chartered Accountants of India and a law graduate from Mumbai University, has more than 3 decades of experience in income tax advisory, compliance, and litigation. He is a partner, tax and regulatory services with SRBC and Associate LLP, looks after tax litigation and advisory. He worked with BSR and Company and practiced in the firm name AM Thacker and Company. Was the president of the Chamber of Tax Consultants for the year 2021. Member of the core group of Bombay Chartered Accountants Society and the Chamber of Tax Consultants. He's written articles in various newspapers, business magazines, professional journals, and online portals. He's contributed papers and spoken at seminars and conferences for professionals at various bodies, a list of them, and has appeared on television as a guest speaker for business channels like CNBC 18 and the Bloomberg, NDTV, etc. So I would request everyone to please welcome him with a huge round of applause. And I request Secretary WIRC, Saurabh, to please present a moment to Anish Bhai.
Hello. Dhyana Moolam, Gurur Murti, Puja Moolam, Gurur Padam, Mantra Moolam, Gurur Vakyam, Moksha Moolam, Gurur Kripa, Om Shri Guruve Namah. Invoking the blessings of the Gurus and also Lord Swaminarayan. We are in, Yogi Sabha, which is a very pious place. Lord Swaminarayan was one of the saints of this part of the world, Gujarat, in the 16th and 17th century, and is very well revered. I personally also follow the Swaminarayan faith, so Jai Swaminarayan to all of you. At the outset, let me thank WIRC. Let me thank Drushti, Arpit, Saurabh, and the rest of the office bearers for inviting me here and also giving me the topic which I believe is very challenging, at least as far as I am concerned. Thank you, Murtaza. Again, you're a very dear friend and you probably have spoken so well about me that I now find it a little difficult to, and I hope that I live up to, the nice words that you said about me. Thank you so much. So therefore, without too much of ado, let us begin. And what we are looking at today is bogus billing and the tax aspects relevant thereto. And the question is really why? If you would have seen something like this in the newspapers, where there have been, at least on the insurance industry, my background is financial services. Okay, I have practiced as a tax consultant to financial services players for the last 2 decades before I actually moved to litigation. So I have been on the advisory side for some of these companies over the last couple of decades. And the whole challenge was in this, that there were actions which were taken both by the GST authorities as well as the income tax authorities on certain intermediaries and insurance agents. And before I begin, let me tell you that number one, the views that I express here are completely personal. They are not SRBC's views or EY's views or any firm's views, right? Views are absolutely personal. Two is that whatever we speak as instances are completely fictional. They may be based on fact, but they are completely fictional. And thirdly, as I was mentioning, I am not a subject matter expert in this. My friend Amit Khatiwala was joking that you are going to teach us how to do bogus billings and you've never, done something like this in your life. I said, boss, I'm not going to teach you how to do bogus billings. This audience is probably going to teach me how to do that if I need it, which I don't. The whole point is that we are going to just take a look at what has happened in recent times. We're going to analyze where this falls. And we're going to kind of look at what can be the possible consequences. And to that, let me thank WIRC because the topic is very, very contemporary. For me, it is challenging because these are certain things which even frankly had taken me by surprise. Some of the things which I'm going to talk about actually took all of us by surprise in terms of the things that were actually done. So anyway, be that as it may, as I said, all instances are fictional. Now take the case of, and let us kind of consider a simple case study of an insurance company. Insurance, as we all know, is a push product, right? And therefore, we need distribution for insurance to be sold. Nobody goes and buys insurance on their own. All of us have been the target of pesky calls by most of these insurance companies. And also, agents who actually come and visit you in person and try and sell you insurance, right? So from that perspective, obviously, we all know that insurance is a push product. And therefore, insurance does require distribution by specific individuals. Again, these individuals are designated or registered as agents with the IRDA, right? The Insurance Regulatory and Development Authority of India. And of course, these agents, there are lot of regulations in terms of how these agents must behave. They can't be agents for more than a particular number of insurance companies. They can't receive commission beyond a particular point. Now, the reality of life is that whenever you control something, right? We all know that when prohibition was the law in India, right? The number of illegal, liquor sales went up significantly. So human tendency and human behavior cannot be changed. And therefore, what happens is that typically when you want your agent to perform, you will need to incentivize him to perform. And since there is a regulatory cap on what the agent can get paid as commission, you will typically find ways and means to pay him something more. Now, you may not necessarily pay him because the agent is typically one single individual or one single corporate. They need cover fire. They need support in terms of creating brand awareness, creating product awareness, printing out forms, distributing forms, so on and so forth. So these agents typically tie up with certain associates or cohorts of theirs. They can be related parties. They can be fathers, mothers, brothers, sisters, sons, daughters. They can be somebody who is, so typically you would have, say, I'll take our own example. A chartered accountant who has an agency in his wife's name. But there are people in his office who help him to do this, right? So it is not uncommon to have different people who help you to sell. Now, these associates or cohorts or nominees, as you may want to call them, these also need to be remunerated. And the remuneration or the commission cap that you will have for an agent may at times not be sufficient for the agent to kind of incur these expenses. So therefore, there is an arrangement which happens with the insurance company where the agent tells the insurance company that, look, I need what is called cover fire. I need support in terms of creating awareness, in terms of helping the sale or the sale of these policies. And therefore, there are these people who you will need to pay. Now, these people can be hundreds and thousands of people because ultimately insurance companies operate across the whole of India. So it is practically impossible, right, to manage these, hundreds and thousands of people, to keep a track of how much they should be paid, etc., etc., etc. So these insurance companies typically went and hired aggregators or intermediaries who were people only did the movement of money. The service was rendered by these associates or cohorts or nominees to the insurance companies themselves, right? And therefore, this is something that we're looking at. Now, the way the billing worked is that the insurance company received an invoice from the payment aggregator. The payment aggregator or the intermediary in turn received invoices from these cohorts or these nominees. And the question was, when these intermediaries were looked at by the GST authorities, the GST authorities found that these companies had a large turnover and they were claiming a large amount of input tax credit, which then led to the investigation. The investigation at the intermediaries revealed certain very startling facts, and these are all hearsay. I have not seen any documents. I have not met any of the officers concerned. Chartered accountants are not allowed to go and attend before the income tax office, at least as far as the insurance companies are concerned, right? The investigation wing has been very, very clear in this, that they don't allow any of us to go. But from what you understand and what you hear through informal conversation is that these intermediaries sometimes did not even have the requisite infrastructure. So there could be somebody who is sitting in a 10 by 10 room, right, having only one person, right, he himself, one table, one chair, one laptop, doing thousands of crores of turnover and claiming hundreds of crores of input tax credit. This was something that the GST authorities discovered, And therefore, there was also an inquiry on the insurance company. And of course, the inquiries are still going on, but there is an allegation of bonus billings. Also, these insurance companies sometimes have relationships with banks. And there is something called bank assurance, where a bank can be an insurance agent. And we all know, right? Typically, these private banks, when the relationship managers come to you, they try and hawk different things, mutual funds, insurance, so on and so forth. So this bank assurance is also one model. And the tax authority thought that these banks are also somewhere involved. So this went to the banks as well. Okay. Investigations are still undergoing. I think there have been certain things which have been found, which we will not look at. But the whole point is that this is going to become a big issue because the amounts involved are staggering. Now, of course, these are some of the numbers that the press are reporting, right? They're not commenting on whether these numbers are accurate or not accurate. Let us go to now our subject proper, which is called bogus billing. And why I gave this context or this introduction is that what we will discuss today is more in this context rather than the context of bogus purchases, etc., which has been beaten to death. We will look at bogus purchases very briefly, but we will not look at bogus purchases as one of the focus areas of this discussion. Now, what is a bogus bill, right? What is a fake invoice, right? Bogus bill and fake invoice essentially are the same thing. Both income tax and GST use this terminology of fake invoice. Okay. So what is the meaning of the terms bogus or fake? The term, as per the law lexicon, means spurious, not genuine, sham, bogus, check, bogus, fake, counterfeit. So therefore, what we would understand by bogus bill is a bill which has no underlying goods or services which are supplied as per that the description there. And this is something which seems to be echoed both by income tax as well as GST. If we look at the memorandum explaining the provisions of the Finance Bill 2020, where a new section was introduced called Section 271 AAD for provision of penalty on somebody who issues and uses fake invoices, right? The memorandum seemed to say something like this. It said, in the recent past, after the launch of GST, several cases of fraudulent income tax credit have been caught by the GST authority. In these cases, fake invoices are obtained by suppliers registered under the GST to fraudulently claim the input tax credit and reduce their GST liability. These invoices are found to be issued by racketeers and who do not actually carry on any business or profession. They only issue invoices without supplying any goods or service. And I think this is very important, that income tax and GST both recognize and understand a fake invoice as an invoice where there is no underlying supply of goods or services at all. Right? And obviously, these are some of the reasons why fake invoices or bogus bills are issued, right? False claim for expenditure, availing input tax credit without receipt of goods and services, reducing GST liability, increasing turnover for availing of bank loans or for higher valuation, so on and so forth, siphoning of money, money laundering, of course, to avail export benefit, because as you know that when you export, you get a refund of the input tax credit. So these invoices are sometimes also in a way purchased or consumed by exporters. And of course, encashment of accumulated input tax credit. So this seems to be the reason for issue of the fake invoice. And really, again, Uh, we understand very clearly that these are different from inflated or deflated bills. So bogus bill is not equal to over invoicing or under invoicing. I'm not going to really get into all these details. I think we know that. But we have to understand that it is different. In and over and under invoicing, the values change, the movement of goods or services happen. It's only values that increase or decrease. Whereas in bogus bills or fake invoices, no goods or services move. Now, really, if I see there is a circular which the GST department brought out on 12th May 2019, which talked about how these bogus invoices result in misuse of the law. And there were 3 instances that this circular effectively mentions. Okay. First is that when an invoice is issued without supply of goods or service, then payment where it is made by way of tax credit, which is not available to the issue of invoice, there is no receipt of goods or service, and therefore somebody only merely issues the invoices and shows payment of tax. So the person may or may not pay tax, and therefore there is a loss of revenue where the buyer of the invoice actually avails the input tax credit, which otherwise is inadmissible. The second instance that the circular seems to talk about is where an invoice is issued to one person and the goods are diverted to some other person. So here what happens is somebody else consumes the invoice and another person actually consumes the goods, right? So there are 2 consumers. The consumer of the invoice, right, may utilize the credit for payment of taxes at that time or for export and claim refund, resulting in loss of revenue. The third instance is an instance of circular trading, where invoices are passed through multiple entities in multiple chains and in a circular fashion to increase the turnover, which of course violates Rule 16 of the GST rule, which provides that to avail input credit, the buyer should actually have a tax invoice and should also have received the goods or services. Here, there is no receipt of goods or services. And the intention is very clearly to defraud the revenue and the banking system. You should all read the circular. It is a good circular. It has, all the salient features of the fraud, how to detect, so on and so forth. How to detect is, again, it's a matter of common sense. You see whether on the same address, there's a lot, there is more than one GST registration. For the same PAN, there is more than one GST registration. And then how do you investigate? So there are certain guidelines which have been issued to the officers by the GST investigation wing in terms of how to do this. This is a public document. I think we should all go through it. Now, looking at the legal aspect of all this, what is the onus of a taxpayer to establish genuine, right? If we see how civil law looks at it, in a civil case, the initial burden is always a prima facie burden. So when a tax officer actually says that this invoice is fake, then he only raises a prima facie doubt on the invoice being fake, right? And prima facie, the explanation given by the taxpayer is not credible, or then there is no explanation at all. Once the taxpayer gives an explanation, then the onus actually shifts back to the department to prove that the explanation given by the tax officer is false. So let us take a case where, in our insurance example, the intermediary is served with a show cause notice saying that you have issued a fake invoice. Now, what the intermediary can say is that, look, I have rendered services. That service is of aggregating payments and coordinating the service of certain other people. I have aggregated the amount of the invoices of several people and actually build the insurance company, right? If the intermediary has in his possession certain documentary evidence of invoices or services or goods being supplied by the endpoint, the cohort, the nominee, the associate to the insurance company, then it would be that the onus would then shift onto the department to say that this explanation is false. And therefore, the invoice that is issued by the intermediary is fake. We're not on what will happen. What will happen will, time will tell. Maybe 2 years down the line, we'll be still talking about this. But as of now, at least, what one believes is that it is all a matter of furnishing of evidence. And if there is certain evidence furnished, then one should not really be required to prove beyond reasonable doubt, as is the case in criminal proceedings, which is the next bullet. Because if you see the GST circular, it also says that furnishing of fake invoices is a matter which is punishable under the Indian Penal Code. Okay. And therefore, if there is indeed a criminal proceeding which is initiated, then the burden of the prosecution becomes a little higher as compared to what it is in civil cases. Because you have to then prove beyond reasonable doubt as to the culpability of the accused. So from that perspective, in civil case, if the officer raises a prima facie doubt, the onus goes back to the assessee. Assessee furnishes certain statements, certain evidence, and we'll see some decisions where if the sales tax department has actually alleged something, but our income tax department has not made any further inquiry, then the courts have struck down the addition. We'll come to that in a little bit when we look at, the income tax provisions. But the whole point is that we need to understand when the onus will shift, because it is very important at least to gather prima facie evidence with your client, right? You may have some of these cohorts as clients. You may have some of these intermediaries as clients. You may have some of the insurance companies as clients. Today, we are in a blind spot. We don't know what is going on. But tomorrow, when the proceedings actually start, today still, statements are being recorded, people are being summoned, all of that is happening. But tomorrow, we will need to look at where the onus will lie and when the onus will shift, which is why it is important. Now, again, I think all of this is fine. We've seen that in an income tax case, when a statute places burden of proof on a taxpayer, it is obviously the initial burden only. And accordingly, therefore, where the addition is made with no further attempt on part of the assessing officer, the same will not be justified. We'll see some cases as we go along. Now, look at this situation. When A claims a deduction of any expenditure, then the onus is obviously on A to show that the invoice which represents that expenditure is not bogus. Where A discharges prima facie, saying that, look, this is the person who has supplied me the invoice. This is the check that I have paid or the payment through banking channels that I have made. This is the kind of service that I have received. I have some, say that if there is a hoarding put up, then there is a photograph of a hoarding wherever it is put up, right? You may not have it for the entire 365 days, but you may have it for say 1 week in a year. But then the onus will actually shift to the department to prove that your explanation is not right. In goods, it is easy because you will have delivery receipt, transport receipt, railway receipt, delivery challans, so on and so forth. In services, because they are intangible, the proving is a little more difficult. And the proving is a little more difficult because ultimately, say there are services like, I have seen cases where there is only word of mouth publicity. There's a payment made for word of mouth publicity. It's a third party. So you will never be able to actually catch somebody on reasonableness unless the preponderance of probability is very, very, against the assessee. For example, say that I did word of mouth publicity to the amount of people sitting in this hall, but I was charged 5 crores for it, right? And the insurance company paid the intermediary 5 crores also. That would be against the preponderance problem. But so long as it is within reasonable limits, then nobody can actually question the payment because it's a third party. Therefore, the department has to then find out different things. And believe me, when the investigations are happening, the department is actually trying to find out things. They are taking copies of your phone. They are retrieving deleted WhatsApp chats. They are taking backup of your hard drive on the computer, laptops of specific people. Because what they did is, they first asked the intermediaries who they raided to say that, aapke saath kisne kaam kiya? You give me specific names of individuals, right, from both the sides who have been in touch with. They have proof of WhatsApp chats. They have proof of emails being sent to those people and received from those people by the intermediary. So now what they have done is that they have gone and specifically issued summons to those individuals, not to their employers, right? But the specific individuals involved. And they are asking them very, very pointed questions. They're asking them to clone their mobile phones. They are able to retrieve WhatsApp chats at least 1 month old. Whatever you have deleted in the last 1 month, they are able to retrieve. I don't know what technology they use. But therefore, it becomes very difficult for a taxpayer to disclaim something, right? So हमको लगता है हमने ये delete कर दिया and that's the end of the matter. Probably it may not. But services are intangible. Point is that it will take some proving in terms of how the services will be relevant. Again, owners to establish genuineness is just Roshanti Hatti and Kale Khan Mohammad Hanif's cases, which say the same thing. This is in the context of unexplained receipt. The same will apply in the context of unexplained expenditure. PPT will come to you, so you don't have to worry about all this. But the whole point again is that you will have to be extremely careful. Tell your clients not to delete anything, because once you delete, then the, how do I put it? The level of suspicion of the tax office goes up many, many fold. Their trust on you becomes very minimal. And therefore, those people have had a hard time. I have had one person who has attended the office of the investigating authority for 1 month continuously, right from 11 in the morning to 11 at night. Of course, they have been civil in the sense that they have allowed restroom breaks, they have allowed lunch breaks. But believe me, the level of interrogation that they do, and they are far more civil than GST. GST, I am told, can abuse. GST can threaten. Income tax threatens, but they don't abuse. I have never, heard any instance where any income tax investigating authority has abused somebody, but GST did. So it is difficult, and therefore, once something is proved to be bogus, it's a challenge. Now, 2 instances where I believe there is some doubt whether these are bogus or not, where the actual goods or services differ from whatever has been stated in the bill. Say I state in the bill that I have provided advertising services. The evidence actually proves that I did not do advertising, but I did something else, right? I did some sort of consulting. I did some sort of support work in terms of, picking up forms. I did some sort of support work in terms of, doing mass mailers, right? All of this, to my mind, cannot be bogus bills. The reason is that there is some underlying service at the end of it. But again, today, unfortunately, these provisions are new. We do not know what stand the government will take. But looking at what we saw earlier, both in the context of the explanatory memorandum to the Finance Bill 2020, as well as the circular of the GST, one would want to take a view that if, God forbid, this ever goes to court, then that defense is available to the assessee, saying that this is not a bogus. Second, where sorry, the bill is in the name of one party, but goods and services are rendered by some other party. There also, again, there is some provisions of goods or service. So it is not possibly a fake invoice. Again, this may be slightly more difficult to prove, because if I see the GST circular, there is some hint towards an instance like this. But again, if something is found, you have essentially no choice. Now, let's go to very quickly the income tax implications, because we've only got half an hour. So, really, there are two parties to any fake invoicing transaction. One is somebody who is the issuer of that fake invoice. The second is somebody who is the consumer of that fake invoice, right? The third may be somebody who helps these two. We are not concerned with that. From that perspective, that will be only the person who will earn some sort of fee. But let us see what happens and what are the provisions that we need to look at as far as the issuer of the fake invoices are concerned. Now, if you see some of these, decisions which deal with commission, brokerage, etc., there the thrust seems to be that only the amount that that person earned for issuance of the fake invoice is something that should be taxed in his hands, because he received the value of the invoice from the other party. He somewhere gave the money back also. So he earned whatever spread that he would have earned in terms of issuing that fake invoice, whether it is 5%, 10%, 15%, 25% is not our concern at this point. But unless there is an invocation of Section 68, which we will come to in a little bit, the amounts that can be taxed in the hands of the person who issues the fake invoice is only the amount that he would otherwise have earned, right? And these are some of the decisions which will help to prove this. This is also a decision of ALPS, which is in the Bombay High Court, where again the same thing has said that ultimately you can't tax the entire amount, right? Alag securities, sorry, not ALPS. Alag securities, where you can't tax the entire amount, you will only have to tax a certain percentage of the invoice, right? Now, coming to one more section which we have to take care, which is introduced by the Finance Act 2022. This is the section called Section 79A. And what this section says is that where there is an addition of undisclosed income, which is made pursuant to either a search, a requisition of books of account under Section 132K, or a survey other than a TDS survey, then no brought forward loss or no unabsorbed depreciation would be allowed. And what is an undisclosed income is defined pretty widely. Just pay attention to the underlined amount, where income which is wholly or partly represented in the form of an entry in respect of an expense recorded in the books of account or other documents maintained in the normal course, and which is found to be false, and which would not have been found unless the search or survey would have taken place, is also called undisclosed income. Of course, on the income side also, if you see the first bullet, it gets covered. So both your income and your expenditure will get covered as far as Section 79A is concerned. 2 points we just need to note before, coming to that is, of course, when this provision was introduced by the Finance Act 2020, Finance Bill 2022, it said that in cases where you have additions under Section 68, 69, 69A, B, C, there is a provision which specifically debars you from claiming brought forward loss or unabsorbed depreciation. But in cases of declarations that you make during these things, where these are not in the nature of this, you just make general declarations, then you still get the benefit of unabsorbed depreciation or brought forward loss, and therefore you should be able to avoid tax. And that is not the idea. The idea is that when you have declared something in the course of serious proceedings like search survey, etc., you must be penalized and tax must be recovered by the government. So Section 79A has been introduced by the Finance Act 2020. 2 points. One, it only talks about brought forward loss and unabsorbed depreciation. So your current year's loss and current year's depreciation can certainly be set off against this income. There's no doubt there. Second point is, if you have income which is otherwise not of the type that you have declared under these proceedings, then obviously you can claim your brought forward loss and unabsorbed depreciation against that other income. But again, this is something that one will have to be careful. Earlier, we used to plan that if we have brought forward losses or unabsorbed depreciation, we should be in the clear. And sometimes, we just kind of overlook some provisions. So please don't overlook this. Now, as far as the consumer of the invoice is concerned, and before I go there, let me also touch a little bit upon Section 68. 68 says, if there is a sum credited in the books, okay, so if I am issuing an invoice, there will be a sum credited in my books. That is not explainable. Then there is addition in my hand. Now, I would think that there is an explanation available. There is a source which is explainable, that the amount came from the person who ultimately consumed my invoice. And therefore, to my mind, 68 cannot be made applicable to the issuer of the fake invoice. Again, as I said, this is something that I personally believe, but facts may seem, these are all very intricate issues of fact. And what is it that has been found and what is it that has been alleged with what conviction is something which always will tilt the balance in favor of one side or the other. Now, of course, in bogus purchases, we all know that as far as the consumer of the invoice is concerned, there will always be only an addition of the gross profit element, because there is always a sale which accompanies the purchase of that invoice. So from that perspective, I think now it has been settled. More or less, tribunals have accepted that 12.5% is what typically gets added. But there are certain other cases where other amounts also would have been added. But again, more or less, very clear in this case of NK Industries that we're talking about, 25% was added, SLP was dismissed. The whole point again is that there should be, unless there is something which is something in the nature of Section 68, then and only then the whole amount can be added, otherwise cannot be. Now, we were talking about these instances where there is something that the sales tax department finds, right? But the income tax officer does nothing. He just takes the information from the sales tax or the GST department and he makes an addition. In those cases, there are a series of decisions to say that unless the income tax officer himself carries out some kind of independent inquiry and finds something as a result of that independent inquiry, the addition cannot be sustained. And these are all these decisions, including one of the Supreme Court in Odeon Builder, where ultimately now the principle is very clear that merely on the basis of anything that another authority tells you, there can be no addition on that basis unless the officer himself makes an inquiry. So again, in Nitin Lohia's case, also the Bombay High Court again said the same thing, that ultimately, just because the sales tax department says these are bogus purchases, it cannot be held to be a bogus. Now, there is one more section which we have to be aware of, which is section 69C. Section 69C says, where there is any expenditure which is found to be made by a particular assessee, and the source thereof is not explainable, then obviously section 69C can be invoked. So again, where you only buy a fake invoice, there is no expenditure, maybe section 69C can be invoked. Again, there is debate on whether it can be invoked or not, but there is something that you will have to kind of take care that don't fall, at least in a situation where you have section 69C, because again, when you buy an invoice, you have made a payment, right? You have made a payment to a certain person, so the source is there. Only thing is the goods are not. And therefore, as we saw earlier, all that somebody can add is gross profit, but this is one more section which the department can try and throw at us. Again, this is a discretionary provision. So the word in section 69C is may, it is not shall. And therefore, it is not automatic that where 69C is invoked, the addition has to be made. It is up to the discretion of an assessing officer. In the faceless era, कोई कुछ नहीं करेगा. Of course, ये सब होगा तो शायद आपका assessment भी faceless नहीं होगा. वो अलग बात. But one will have to be careful of 69%. Now, there are some decisions which we will not go into. I think we don't have the kind of time. So let me move straight to section 115 BBE. Now, section 115 BBE is a section, and I think this again we've been debating for time immemorial. So we'll not probably spend too much time. But section 115 BBE assesses your income, which is of the nature which gets covered by section 69, 68, 69, 69 A, B, C, D to a rate of 60%. There is a surcharge of 25%. There is an education cess of 4%, right? So total tax effective is 78%. When you add penalty under section 271 AAC, which we will come to when we look at penal provisions, right? That will increase your effective rate to around 85%. Now, again, of course, no deduction in respect of any expenditure, allowance, or set off of loss shall be allowed to you if this section is invoked. So it is a stiff cash out for the taxpayer. Now, two things as far as 115 BBE is concerned. One is it applies only from the assessment year 16-17. And therefore, if there is any addition for any prior year, then it is strongly arguable that 115 BBE should not come into the picture. Again, there is the decision of Vijaya Hospitality, 419 ITR 222 Kerala, and also a CBDT circular, which kind of takes us there. So 115 BBE, one will have to be wary about if we get visited with consequences under 68 or 69 A2T. Now, there's one more section which, in the context of the case study on insurance that we were talking about, which typically will apply to the insurance company who's actually consumed the, is the explanation to 37.1. And what does this explanation say? And there are two explanations which are relevant, right? There are three explanations to 37.1. One is obviously the first explanation, which says that any expenditure which is incurred for any purpose which is an offense or which is not in accordance with any law for the time being enforced has to be disallowed, and it cannot be regarded as expenditure having been incurred wholly and exclusively for the purpose of your business or profession, right? There is also explanation 3, and which is very important, because ultimately, if in our insurance case study, it is proved that this payment made to the cohort or the nominee or the associate is nothing else but a surrogate form of paying commission to the agent, then you will visit yourselves with consequences under explanation 3. And explanation 3 says that any expenditure incurred by an assessee for any purpose which is an offense or which is prohibited by law includes and shall always have deemed to include, right? Expenditure for any purpose which is an offense or which is prohibited by any law inside or outside India. And this was more for the pharma companies having FDA violations, right? So that is not important. This second part came in for doctors, but it will equally apply, I would believe, to cases like what we're talking about, where it says to provide any benefit or perquisite to a person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or regulation or guideline governing the conduct of such person. Now, for this to happen, obviously, the level of proof for the department has to be that the amount has indeed inured to the benefit of the agent of the insurance company. So you will typically see, at least from what I have seen, that the bank trail shows that the amount only goes to the associate or the nominee, the cohort, the relative of that person. It doesn't flow to the agent itself. And so long as that is not there, one may have a fighting chance. But obviously, of course, if that person is summoned and that person somewhere makes a confession or an assertion to say that this ultimately is nothing else but insurance commission, which I needed, I have received for and on behalf of my associate, who is the agent, then obviously this explanation will ultimately go and hit you. And, we look at one Supreme Court decision which was rendered in the case of Apex Laboratories, very famous Supreme Court decision. But I would think that very relevant and some very disturbing observations are actually made in that decision. Now, this was a case where, of course, freebies were provided by the pharma companies to the doctors. But the observations of the Supreme Court are a little damaging. Let us see what the Supreme Court said. So, obviously, Supreme Court said that explanation 1 to 37 will operate retrospectively, which is fine. It then goes on to say that if the acceptance of freebies is punishable as per the Medical Council of India, then pharma companies cannot be granted tax benefit for the same, thereby actively and with full knowledge of commission of such acts. So what the pharma companies argued there was that, look, there is no prohibition or there is no rule or regulation of the Medical Council which governs us as pharma companies. It is only governing the doctors, and the doctors are prohibited from purchasing or accepting the freebies. But there is no harm in me giving. So don't come and penalize me. And Supreme Court said nothing doing. What is illegal for the doctor has also to be illegal for the pharma company. And therefore, you are also a party to that illegal act. And therefore, we cannot be. Now, in the insurance regulations, interestingly, Insurance Act has two sections, sections 40 and section 41, where there is, in fact, unlike in the pharma case, a prohibition for both the agent to receive and the company to pay. So this apex argument, which anyway was negative, will never probably be applicable if the insurance company has to pay. The third observation is even more damaging because this will apply in the insurance cases also. What the Supreme Court said is that these freebies are actually not free, right? The cost of the freebies gets added to the cost of the drug. Now, this is also true that whatever commission gets paid ultimately increases our premium. Insurance is something which is regarded even today as a substitute for social security. And therefore, if premium goes up, one has a very big fear that if this argument is taken, then the courts may well kind of look at the observations in Apex and say that, yes, this is again something which is completely antisocial in nature. And look at what the Supreme Court again says, right, in continuation of this, one arm of the law cannot be utilized to defend the other arm. Doing so would be opposed to public policy and bring the law into ridicule. So what chance in hell does somebody have if this gets asked? And last one, we'll leave the fifth bullet there, but the last bullet. The well-established principle of interpretation of taxing statute is that they need to be interpreted strictly, cannot sustain when it results in an absurdity contrary to the intentions of the parliament. Now here, I would think that it will all depend on what sort of case is being made out, how much the department is able to paint the parties to some arrangements in, a not so good light. If that happens, then, the balance of sympathy certainly will be against the taxpayers. Penal provisions, again, 271 AAC, we kind of looked at. The only point that we need to look at under 271 AAC is that the provisions of 270A will not. So you can't have 271 AAC and 270A coexisting. So therefore, if you are already taxed at 85% effectively, then there is no concealment penalty to you. Of course, reasonable cause, etc., and limitation apply. So that's not an issue. The more damaging penalty is this one, which is 271 AAD. Now, in 271 AAD, what the section says is that if there is a fake invoice or a false entry or omission of any entry, which is relevant for computation of the total income in the books of account made by such person, and this false entry is found, then the amount of the transaction will be the penalty under section 271 AAD. And what does false entry include? Use an intention to use forged or falsified documents, or false piece of documentary evidence, or invoice in respect of goods or services without actual supply or receipts of such goods and services, or invoice in respect of supply or receipts of goods or services to or from a person who does not exist. And therefore, I would think that this is the biggest challenge that ultimately will face us when we defend any case of fake invoicing or bogus billing. Because it is not only the person who issues that invoice who is subjected to the penalty. Please look at the section at the bottom. The AO CIT appeals or Joint Commissioner appeals also can levy the penalty. And it can also direct that any person who causes another person to make a false entry or omits or causes to omit any entry to pay a penalty equal to that amount. So both the issuer and the consumer will pay an amount equal to transaction value. Now think about it. 100% of transaction value one side, 100% of transaction value on the other side, right? At the bare minimum, 200% of penalty for misreporting 270A, which we will come to next, right? So therefore, if my average tax rate is 25, or let's take 30%, okay, then my penalty is 260% of whatever. God forbid if I have some circumstance where 271 AAC gets invoked, 60 will go, but 85% will sustain. So 285%. So the consequences are serious, and we'll come to prosecution as well. But I would believe that the consequences are, in that sense, really, really serious when it comes to fake invoicing. So don't take some of these things lightly. Tell your clients not to kind of indulge in. 270A, again, penalty for misreporting. One of the cases of misreporting is a claim of expenditure not substantiated by evidence or recording of any false entry in the books of account. So therefore, this will be a misreporting penalty and you will also not get 270AA waiver ka benefit. So please be careful. Again, of course, penalty is discretionary, but in cases like this, I don't know who will ultimately be sympathetic towards the taxpayer who actually does something like this. Last but not the least, we are not scaring you, but prosecution certainly you will have. There is section 276C, which provides for punishment in case of a willful attempt to evade tax, penalty, or interest for underreporting, right? And that is 6 months to 7 years, rigorous imprisonment. Okay. And 3 months to 2 years in other cases where the tax is less than 25 lakhs. So from that perspective, there is prosecution under section 271, 276C, right? And there are pretty stringent provisions under section 277A also, where there is falsification of books of account or document. Again, it is punishment is 3 months to 2 years and fine. And of course, there is an aiding and abetting prosecution as well, which will, again, the prosecution is similar to what you have under 276C. And second offense, again, there is a provision under 278A. With that, I think let us end this session. I would believe that, something which is completely against the provisions of law, against the tenet, has to be penalized very harshly. There are provisions under the Act where very harsh consequences of bogus bills, etc., have been, laid down. And one will have to be extremely careful when one takes cases like this, because ultimately it is also, how much you'll be able to defend a client, that will be more important. Moral is one thing, but what is the balance of convenience against you is something that each of you will have to kind of look at. With that, let me take any questions from the floor, if any questions are there. Depends on what sort of role that you play, right? If there is some evidence to show that you have actively collaborated in the issue of the fake invoice, certainly yes. I believe it's a matter of evidence. Ultimately, it will be a matter of what evidence is there against you. But yes, I'm presuming none of the distinguished audience here ever does something like this. Yeah, Mike. एक मिनट
सर सही है. In case of a bogus purchase matter, department has traveled to High Court against the partially favorable order of tribunal, whereby the addition is purely on the basis of GP percentage addition. What are the chances and whose chances as to success in this?
Difficult to say unless we have facts, but I would think that typically, at least now from what I have understood, is that if there is a percentage addition, then the only thing that the High Court will do is vary that percentage if it feels something is up. I would not think that somebody will do something more drastic than.
So this question from me. Your case study on insurance was quite interesting. And
It's all fiction.
so I cannot comment because it's all in the newspapers, presumably. So whether in that context or in any other context, let's say in your view, if there is somebody who has gone out advertising space, then is the onus to prove that the space was actually utilized, given based on or falls on the head of the person providing the space or the one who is going to use it?
Sir, it will always be for the one who would use it, right? In terms of whether you have utilized. For you, you have the space and you've already issued the invoice to say that I have already let out the space to somebody. Ultimately, the deduction is going to be claimed by the user. You are only showing income. You've already offered that income to tax. For you, I believe there should be very little consequence unless, yes, somebody says that, okay, the person who has used it confesses that I have not used anything like it. Then it may ultimately go to unexplained cash credit. That also is a matter of proving of evidence. But for the owner of the space, I think it's very, the consequences should really be very, light as I see it.
Thank you, Anish.
Hello, sir.
Yes.
So this department nowadays has been invoking section 69A. I have seen in the cases where the cash is deposited in the bank and the said entry or the bank account is been recorded in the books. So I mean to say that the bank is the part of my books of accounts, cash deposit is been recorded. So what is your view whether 69A can be invoked because the entries are passed in the
Are
books?
there not decisions to say that bank passbook is not your books of account, it's a record of the bank?
No, sir. I am actually maintaining the books of accounts. I am a proper company maintaining the books of accounts. The cash deposited is a part of my.
But then you would need to have some sort of explanation for the cash, right?
There is an explanation. That's my part of my cash sales.
Right.
But the moot question is, can 69A be invoked in such case when the transaction is recorded in my books of accounts?
I would think if there is an actual sale that you can evidence by way of a proper invoice, by way of goods moving out of your factory or your office or go down or wherever, then I would think that the answer would be no, right? I would find it very difficult to say that, this is a false entry.
So my moot question is a preliminary question that keeping aside whether I am able to prove that sales is genuine or not. But since the transaction is recorded in my books and the entries is passed in the book, whether 69A can still be, because 69A says that the transaction which is not recorded in the books of accounts, money, cash, bullion, jewelry, found with the assessee not recorded in the books.
Absolutely. So if there is a credit in your books of account, then the only addition that can be made is 68, if at all.
Correct, sir. Correct. Okay, sir. That's what, because the department has been consistently invoking 69A in such cases. So that's what I just thought that is there any other
Sometimes
view?
what the department does is beyond anybody's comprehension.
Absolutely.
There is a case which I know of where there is a sale of a capital asset, okay, by one person to another. Department is alleging that to the extent of 11 UA, that amount is capital gain, the 11 UA value. Anything over and above that 11 UA value is addition under section 56. So department can do anything. Ultimately, yes, I would think that, one has to have faith in the judiciary to say that ultimately justice will prevail, right? Anything which is completely, unexpected, which is not in accordance with the law in court, how can it stay? That much faith we all must have. It's a democracy, I think.
Hello. Sir, even coming to 68 of this question, in 68 in my books of account, I say it is my cash sale. Then how once I show it as an entry of a gross receipt, how again 68 can be invoked for unexplained cash credit?
No, it can't. So I said if at all. I did not say 68 will be invoked.
No, even in such cases, the 68 is also in case of
No, which is why in all of these things, again, it will always have to be a matter of what exactly the department is alleging versus what you have as your facts, right? If there is a proper entry, you are showing it as sales in your books, the sale is genuine, then why should there be any question of even 68 applying to any of it?
Sir, all the demonetization, cash credit, even though they have been shown as the sales, demonetization, they all have been 68 is.
Yes, they have been doing that even in cases of unfortunately banks. So, it is completely baseless, I would think, right? Okay, I guess. Thank you very much for a patient hearing. Thank you.
What a wonderful session we had. Great in terms of knowledge and highly insightful. Let's have a big round of applause for Anish Thacker, sir. Now I request my regional council colleague C.A. Sweta Jain to propose well-deserved vote of thanks to faculty of the session, Anish Thacker, sir.
Thank you, Saurabh. I think, of course, we should give him a very, very loud of applause for this wonderful, informative session. Sir has covered all the aspects, start with implication, consequences, and penal provision. Sir, on behalf of WRC, I really would like to present our grateful, we are grateful to you for your sparing your valuable time and knowledge with all of us. Thank you so much. Okay, so we are starting our second session with the little dice changes. Please be with us.
We are starting our next panel discussion immediately without taking any break. Break will be done at the end of the session. And this is the last session of our DTRC. I request everyone please be seated so we can start this.
Okay, friends. So let me again take this opportunity to thank C.A. Anish Thacker for the excellent session. And let me now request immediate past Secretary Sweta Jain to escort the moderator for this panel discussion, C.A. Ameya Kunte. Ameya, please welcome Advocate Chythanya and C.A. Amrish Shah. Let us welcome them with a huge round of applause, please. So let me welcome Advocate Chythanya. He is a senior advocate and he's traveled all the way for us from Bangalore, spending the whole day. So, Chythanya ji, welcome and thank you for accepting our invitation. We really appreciate your efforts. Thank you very much. See Amrish Shah. Amrish bhai, thank you for accepting the invitation and sharing and coming here to share your knowledge. And of course, Amey, who's a dear friend. Amey, thank you for planning this whole panel, deciding the topic, and even he's been an extremely good help and support in organizing the whole DTRC, structuring and even getting the speakers year after year. So Amey, thank you. Thanks a lot. Let me also thank the secretary, Saurabh Ajmera and Shweta Jain. Last session of DTRC, interesting panel. As I understand, we're going to cover a little of loans from company to directors, etc. A little on the restructuring bit of it. When one organization is taken over by another, losses gets transferred and things like that. Interesting subject again. So I'm sure it is going to be very engaging and an interesting session to end the whole DTRC, which is a flagship program of WIRC. So with that, let me now request Shweta Jain. Shweta madam, if you can please do the honors of introducing all the three guests on the dais.
Thank you. And it's really a pleasure and privilege for me to introduce moderator Ameya Kunte. He is a tax professional with over 20 years of experience. He specializes in business and transaction tax advisory and cross-border tax. He's a founder of the boutique tax consulting firm Globe View Advisor and earlier co-founded Tax Sutra Chamber of Tax Consultant and IFA. So welcome Ameya, and thank you for being with us today. Now Chythanya sir is a BCom, FCA, LLB, and most importantly rank holder, 47th rank in CA Intermediate and 15th rank in CA Final. So chartered accountant for 14 years, specializing in taxation matters, 17 years in various High Court and Supreme Court, designated as a senior advocate by Karnataka High Court. He has been a faculty at IIM, ICI, and DTC of Income Tax Department and various other forums. He has presented paper in income tax and VAT, GST, and various metros and other cities at forum of ICI. So thank you, Chythanya sir, and welcome at WIRC. Another panelist, CA Amrish Shah. He has more than 30 years of professional experience with large tax and consulting firm. He specializes in merger and acquisition and structuring of other transactions, both domestic and cross-border. He has advises large multinational and Indian companies on acquisition and divestment tax and regularity structuring and due diligence related aspect. Also been assisted them in corporate reorganization, including merger, demerger, joint venture, etc. Advises private equity clients on acquisitions and divestments. His involvement has been with clients across various industries and sectors. Also, he was a part of the CIIA tax committee in 2014, and regularly he contributes through his through leadership on air, in the print media, and before various professional forums. So welcome, Amrish sir, and thank you so much for being with us. So with this brief introduction, I handed over mic to Ameya Kunte, but before that, of course, it is our duty to present a gratitude. So I request immediate past chairman Murtaza Kachwala sir and Saurabh Ajmera, secretary WRC, to present a small memento as a token of appreciation.
Good afternoon. I think on a very lighter vein, I would say it's a sharp 3:30, actually 3:29, and that's the scheduled time of our session. So I think compliments to ICI for keeping the time, and thank you to Anish Bhai as well. The the memento given to us is actually suggests ek now chal rahi hai, and our professional life is something like that as well, particularly in the tax. And we have two fine craftsmen who will make sure that ki now kinare lage at the end of next 90 minutes. The MOC earlier announced that ours is the last session of DTRC. So in cricket terms, these are slog overs. And again, we have two explosive batsmen. I think a big round of applause to them, both of them. Why I'm saying so, he of course lives in Mumbai, but he's just back 48 hours back from London to be with us here. And Mr. Chythanya, more importantly, traveling from Bangalore to here is a, just for this event, requires an amazing commitment towards profession. So thank you to both of you again at the beginning. The topic that is given to our panel over next 90 minutes is current litigative trends where department is trying to litigate on certain issues. And we are conscious of, the audience over here, wherein each one of us in our day-to-day work are faced with tax issues. So we've tried to select some 5 or 6 assorted tax topics. Trust me, these are not covered in the previous session, so there won't be a repetition. But these topics perhaps will help many of us sitting in this room in our day-to-day work. There's hopefully some takeaway. As I said, the theme of the topic is current litigative trends from the department. And as we see at a very macro level, last 1 year, certainly on the litigation side at the Supreme Court, the pendulum has swung in favor of the tax department. There was an era about 10 years back where most of the judgments from Supreme Court were in favor of taxpayers, whereas last 12 months or so, it's the other way. We've seen many significant judgments in favor of department. Some very interesting observations in the context of reassessment, we all know. So the pendulum currently at least is in favor of the department. The statistic shows, of course, Supreme Court is interpreting law as it stands. The second theme that we saw, which is there in the successive budgets, is that anything which is otherwise, completely tax-free, is being taxed at least, at a capital gains rate or a normal rate, and whatever was being planned to be taxed at a long-term rate is being shifted back to the regular tax rate. So all these tax arbitrages are sort of moving away. I think that's the other theme which is there. And third point is litigation landscape itself. While we can debate and juries out on whether faceless is good, whether e-appeals will work and so on, but I think everyone in the room will agree over here that the sheer quantum of tax notices, scrutinies that was happening 5 years back has reduced, and therefore the appeals and so on. I think that's a sort of broad landscape with which we wanted to begin our session. And as I mentioned, we've tried to cover certain relevant topics for professionals here. And let me start with the first topic with Mr. Chythanya. This is on the issue of deemed dividend, section 222E, which is there in the Income Tax Act. And this section has been there since its inception. And you all know the basic concept is that if a company, instead of declaring the dividend, gives a loan to its shareholder or to a group company controlled by the shareholder, this loan is treated as a deemed dividend, and it is taxed at a full rate. This is more like a anti-avoidance provision which has been there in the statute book since the beginning. But this provision, it's like a hanging sword. Many times, business owner, at the heat of the moment when there's a financial emergency, just shift the funds account. They instruct accountant, Baba, yahan se paisa idhar dal do, not knowing 222E gets triggered. And then later on during tax audits, we break our heads, and the consequence is quite severe. Of course, there are further issues on who should be taxed, the shareholder or the receiving company, and so on and so forth. So I wanted Mr. Chythanya to touch upon certain nuances around 222E deemed dividend. The format, like I said, over next 90 minutes or so we will touch upon these issues, and Mr. Chythanya Amrish Shah will take up one issue at a time. I would take all the questions towards the end of the session, subject to the time availability. So, and in the meantime, if you have any questions, maybe write them down and send it to me, so that, you know, we are able to control the time. Mr. Chythanya, 222E deemed dividend.
Thank you, Ameya. Amrish here and the learned delegates. The topics which Ameya has chosen for this evening would throw some inkling about possibly his mischievous childhood. All mischief provisions only has chosen. Like you have 224E, you have 56.210, you have 56.27B angel tax. So this provision of 222E is something that could catch you off guard. It could be a situation where, you are a director in a company, plus you have your personal business, and there is some intermingling of funds. So whereby inadvertently funds of the company may have been used for your personal business. 222E could be attracted. There could be, a group of companies and intra-group transactions. Some fund flow issue could possibly trigger 222E. And it could be a case of a foreign multinational having a subsidiary here as well as a permanent establishment, and some fund need of permanent establishment being catered to by the local subsidiary here. It could be a corporate restructuring like demerger, amalgamation, whereby suddenly you start owing money to somebody else as a result of recasting of your financials. It could be the typical business advances. It could be, issues like certain receipts of funds could take place in overseas jurisdiction, you being a resident in India. These are some of the trappings you might get into, and for which reason you will have to be ready with Section 222E thoroughly. Now, there are two ways of dealing with this particular provision. Firstly, planning. Secondly, defense. Planning is what? Don't ever get into 222E situation. Never get into any adventurous tax planning in the matter of 222E. So always make sure that this provision rings in your mind whenever there is any intra-group transaction, within the closed circuit transactions, etc. Wherever the promoters are involved, wherever the concerns are interconnected, interlacing of funds, etc., you have to be extremely cautious. And we'll have to have some sort of a check button which says that, hey, watch out for 222E before you clear any particular transaction. This is the only planning you could have. Then you will have defenses. Whatever defenses you would have to be used strictly as defense and not for tax plan. Don't ever venture into any of these for the purpose of planning your transaction. So with this background, I would just spend some time, and Ameya kindly stop me whenever I have to stop, because lawyers are known for endlessly speaking. Till the judge over here would stop us, right? He has to say heard, then I'll stop. See, the first and the most raging controversy is, particularly when a company, of course, we are assuming that you would know the provisions, where provisions of Section 2 within brackets 22E. It would seek to hit a company which is a company in which public are not substantially interested. I would call it as closely held company. And if such closely held company were to have accumulated profits, and it either gives advance or loan to a shareholder who holds shares in that company carrying not less than 10% of the voting rights. So there is a company, there is a shareholder holding not less than 10% of voting rights. Of course, you'll have to exclude the preference shares. then if such company were to give advance or loan to such shareholder, then to the extent such company has the accumulated profits, whatever loan so given, irrespective of the fact that it is given as an out and out loan carrying interest or whatever, it will be deemed to be dividend. So first transaction is straight and clear. The recipient shareholder will have to pay the tax. We do not have much of a controversy over that, except that the shareholder will have to be necessarily a registered shareholder, not just a person who is a beneficial shareholder in as much as he is not registered as a shareholder. There is not much of a controversy on this. We'll move into second type of transaction, which is covered here. This has been brought in since 1987. And this transaction is the company in our example, and we have a company and the shareholder. The example remains the same, and the shareholder holds shares in the company, holding not less than 10% of voting rights. And this company would not lend money to him as such directly, but it would give it out another concern, in which concern this person is a member or a partner and is having a substantial impact. It's a triangular situation. So you would not lend, company would not lend to the director as such, the shareholder as such. Company would lend to another concern, the third concern. In the third concern, this shareholder is holding substantial interest. This is where, quite a bit of transactions are caught. And by the time you would realize the damage is done, the assessing officer would notify to you that this transaction took place. It will become fait accompli. There is no way you could have, corrected it now. Now, here is where the most raging controversy is. Who has to pay tax in this triangular situation of company lending to the concern in which the shareholder is having substantial interest? Who has to pay the tax? Should the company pay tax? Should the shareholder pay tax? The courts in this country have consistently held that concern cannot be made to pay the tax because section 2 within brackets 22 after all defines what a dividend is. It deems loan as a dividend. That's it. It would not deem that concern as a shareholder. It stops. By deeming loan as dividend, it stops. The fiction ends. It would not further extend to call the concern a shareholder, and it would be incongruous to make a non-shareholder pay tax on dividend. And for concern, unless such concern itself is a shareholder, a concern cannot be made to pay the tax. The Delhi High Court ended with Ankitek, stated that if at all somebody has to pay the tax, the shareholder has to pay the tax and not the concern. The matter goes to the Supreme Court, and the Supreme Court, in a civil appeal, not an SLP, in a civil appeal, upholds the decision of Delhi High Court, stating that the concern, unless it is a shareholder, is not required to pay the tax. Then a week later, another case comes to the same bench in the Supreme Court, National Travels. The Supreme Court suddenly starts doubting its own decision, rendered just about a week before, and then says, okay, we are not agreeable to the decision which we gave out the last week. So we'll refer it to the larger bench, and a reference is made to the Honorable Chief Justice of the country. Thereafter, the matter is still pending. But as the law stands today, the concern need not pay the tax. But this is not the end of the controversy. Should the shareholder pay the tax? Some of these courts, which as they held happily that the concern is not liable to pay the tax, without much of an analysis, went ahead and said that the shareholder is liable to pay the tax. Now the question is it right that the shareholder has to pay the tax? Please understand section 2 within brackets 22, after all, defines one term. That's it. It wouldn't create a charge. It says what dividend includes. So in a given situation, a loan is called as dividend. That's it. Now, in order that you make somebody pay the tax, that has to fall within the scope of his total income. Section 5 provides that in order that you are charged to tax, you either receive the income or income is deemed to be received by you, or the income accrues or arises to you, or is deemed to accrue or arise to you. In this example where the company gives loan to a third concern, which way it is received by you or is deemed to be received by you, or which way does it accrue to you or arise to you, or how is it deemed to accrue or arise to you, there is no such fiction available in the tax statute. And therefore, the basic fundamental of taxing the shareholder should fail here, which unfortunately the courts have not considered. They have said, okay, shareholder has to pay the tax. We'll pay the tax provided it is included in our total income, which is not the instant case here. And take a situation where, let us say in this concern, there are multiple shareholders who are having substantial interest in the concern. They also have shareholding of not less than 10% in the lending company. Whom are you going to tax? Let us say there is a company, we three are the shareholders, holding not less than 10%. There's another company in which we three again are the shareholders holding 33% each. Who are you going to tax? So look at the decision of Supreme Court in Gangasharan, Govindsharan, 155 TR 144, where the canons of taxation will have to be strictly adhered to, otherwise the tax would fail. The law is unable to fix who is liable to pay tax. So we had an occasion where we were discussing this in our office, and one of our junior most colleagues brought out a very fine point. So why would you expect this person to hold 20% stake in the company? Where is it so stated? I said, look at this, section 2 within brackets 32 defines person holding substantial interest in the company. Section 2 within brackets 32 defines when you are called a person holding substantial interest in the company. It says when you would hold shares carrying not less than 20% of the voting rights. Then you would ask me a very innocent question. So this is a term defined. Show me this term in section 222. There is no such term in section 222 which uses this exact phrase that the company in which person is substantially interested. It is not there. That phrase is not there. The phrase that phrase was used in 87, and after the amendment in 87, that phrase is not there. Then I asked him, would it mean that these people go without tax? He said, no, sir, that is not the way to look at it. Don't apply 20% test. What is substantial? Look at various provisions of the Income Tax Act. Some provisions talk about 20%. If you look at explanation 6 to section 911, it talks about indirect transfer it uses, as was upheld by Kopal's case, authority for advance ruling. It held 50%. So there are, like varied percentages, 20 to 50%. I asked him, why not 20%? No, sir, keep 51%. I asked him why. Sir, only if you keep 51%, you could sustain the taxation because there would be only one person who would hold 51%. You can't have multiple persons holding more than 51%. Therefore, to sustain taxation, court would get convinced if you would argue that it has to be 51%. Look at his ingenious thought process. I'm waiting for a case to use this. So therefore, again, not a planning exercise. It is only a defense mechanism. Another colleague gets up in our office. He says, sir, can we not use ATM for this? ATM. ATM is where, you will have the dividend income coming in. You would give away dividend. I asked him, oh, ATM. Yes. Look at ATM. It doesn't exclude 222E. So you can get into the telescoping advantage of ATM. Then I asked him, okay, I may do ATM, but then that would go to somebody else, and who has to pay the tax? Sir, are you not deferring tax by 1 year? Is it not tax planning? Let that person declare dividend to another person. You can do some sort of teaming and lading kind of. So this again could be another area of defense for the reason that under ATM, you would have time up to the due date to be declaring dividend. So inadvertently, by end of year, you would realize that you received some advance, which would, mean you having to pay tax on it as dividend. What you could possibly consider is giving away dividend if otherwise you are permitted to give away dividend. And not that it's an absolute difference. In the given circumstances, you'll have to subject it to a suitable test. So like this, you'll have, defenses coming in. Take a third situation where something is called, some deposit has been given. If you're able to call it a deposit, a question that would arise is section 2 within brackets 22 would use loan or advance. Now, is deposit a loan or an advance? The courts have held that look where loan is coming, where advance is coming. You have advance and loan which have been juxtaposed against each other, which will mean the principle of nocite ergo sauces. Each takes the color from the other. So what is loan? unless an advance is in the nature of a loan, it would not be called as an advance, and therefore a deposit is a case where the lender has to go to the borrower to recover the money. Typically what deposit is, like in a bank deposit, bank would not come to you to return your deposit. You'll have to go to the bank to collect it. Not in the case of a loan, and therefore the deposit is not a loan or an advance. Similarly, advance given in the, like ordinary course of business, current account payments, etc., also cannot come into the scheme of deemed dividend. So these are some of the aspects which will have to be carefully borne in mind.
Right. On a lighter vein, were your juniors your alter ego, if I may say so? Well, very interesting. Just the point that you mentioned, how to prevent this. And I know in one of my clients, they have some, over 100 group companies. In the SAP system, they have actually coded which are the 222E triggering companies. And the moment you even draw a check from the system throws an alert that this is a 222E entity. So they are able to sort of manage the risk in advance. One quick follow-on question, Mr. Chythanya, on the deemed dividend. And I know we are not looking at this is a direct tax refresher course on the domestic tax. Very briefly, on the treaty scenario, is there a different perspective you see on the 222E dividend? Very briefly.
It's an extremely important question. Slightly complex way of answering it, so you'll have to follow me very carefully. If you see the structure of Income Tax Act, it wouldn't call loan an income directly. It would only first make it a dividend. Section 2, within brackets 22, defines a loan a dividend. Dividend becomes income separately. If you look at section 224, clause 2, income includes dividend. This is one place. Now go to the double taxation avoidance agreement. Leave out the UK treaty for a while. UK treaty would even not only define what is dividend generically, would also say that whatever the local law would call a dividend also is a dividend. So we'll not look at, take Mauritian treaty, take Singapore treaty, take US treaty, those slightly differently worded would in substance mean the same. There, if you would see, dividend would mean an income arising from a corporate right or any such similar thing which the local law would regard as dividend. So it has to emerge as a corporate right. A deemed dividend is not arising as a result of a right. There is no right to receive, just that the loan is given. It is one rare instance of a deemed income. It becomes income upon its receipt. This income is inconceivable to accrue or arise. Now, therefore, most of the treaties would define dividend in a manner to exclude this loan to be regarded as a dividend. So it is not dividend under the treaty law. The moment it is not a dividend under the treaty law, Article 10 or 11, as the case may be, should not apply. Then Ameya would not stop here. He would say, what about other income? So you go to Article 23, 24, as the case may be. It will talk about any other income not expressly dealt with in the foregoing articles could be charged to tax in the country in which it arises. Any other income, this is where you have to be careful. Any other income, that means this particular loan is no more the dividend under the treaty. So I would hold on to the treaty meaning. I would hold on to the treaty meaning to regard as loan not being called a dividend. Therefore, there is no provision in the Income Tax Act which would call, as I have said in the beginning, loan an income. It would call loan a dividend, which is not so as per the treaty, and such dividend is made an income. And therefore, it cannot even fit into being called as any other income because it is expressly excluded from being called a dividend. Again, a defense. Again, a defense. So all these, as I've said earlier, I'll reiterate at the cost of repetition, used to be only as defense, not for the purpose of planning. Therefore, it is immensely possible to regard this kind of a fictional income as not dividend under the treaty, to keep it out of not only Article 10, but also out of Article 23 of the treaty. This is my view. And I guess Mr. Amrish may have a possibly different view on this.
No, first of all, good afternoon, everyone, and thank you for inviting me here and, along with, learned Mr. Cynthia here to, understand some of those nuances. But I think I would maybe look at one more way of how the defense can be created, and I've lived through that. We actually had a situation, what he just said, by error, we had given a loan. Let's say it was somewhere in the month of July, and then there was no way to undo it. I mean, we are really caught. And, being somebody who has a restructuring or bent of mind, what we did is we merged the two companies from a appointed date, which was April 1 of that year. So there was no loan that you can give to yourself, right? And that's how we created a different way of defense, if I can put it, or planning to get out of that situation. But that's one more way to look at it. If you are able to do it for whatever reasons, you may want to consider something like this. If you are caught, after the event is done, or after, your clients come to you and tell you, we have done this, now what is the way out? Many times we are pushed into those situations of finding a way out for our clients. Maybe this is one way out for the clients. And fortunately for me, it was the pre-GAR era, slightly easier. Now we'll have to even create commercial rationale for the merger. So that, we don't give them one more handle that the merger was only for the purpose of avoiding, the 222E implications. So maybe that's the other way to look at it.
Thank you. Fascinating perspectives. Amrish bhai, staying on with you now and moving on to the next theme. Dividend emanates from the equity investments, and the equity investments, I think the country probably has seen a boom in the last 10 years, probably one of the best in the last many decades, where a lot of investment is happening for startups, but even the formal sector, traditional sector as well. And then we know suddenly to deal with the menace of the postbox companies, where the money is pumped in as a share capital, where if I use a crude word of cash being converted into share premium and a tax-free income, to cover a few transactions, department introduced this section 56(2)(7)(b) clause, popularly called as an angel tax. As we all know, what this section suggests is, if a company raises a share capital at a premium, and if this premium is higher than the fair value of the company, then this premium is taxed as an income. Again, deemed dividend, this is a deemed other income, another example of deeming fiction being created. And this problem is compounded particularly in the startup or in the new age technology related investments as well. So next 5-10 minutes, Amrish bhai, your fine print reading of this angel tax provisions, they do seem a bit onerous across the board, but I'm sure there are some finer aspects which you could touch upon.
Thanks, Ameya. I think just to maybe step back, we have corporates for 150 years plus, from 1850. But, it was only after 150 years that somebody thought that a premium can also be taxed. So the first 150 years, nobody ever tried to tax a premium in the country. If you were to just go back a little, there was that just one Supreme Court decision under the old 1922 Act, where, because under the 1913 Companies Act, securities or share premium was considered to be accumulated profits. And if there was any distribution, then, again, just going back to the first topic, dividend was considered out of that. But post 1956, when there was a restriction on premium usage under the Companies Act, there has never been any case that at least I've come across where, a dividend income is treated if somebody else is listening. But just a side. Obviously, we will not cover 68 here because, the other aspect of the premium income is around 68, but we had a full session where Anish bhai, has enlightened all of us on that. So if you look at, the germane of this angel tax, I think it started first, as I call it in, M&A world, with secondary transfers being covered. When it got enacted in 2009 under, the old 56(2)(7) at that point of time.
then got enhanced to, companies getting covered, in June of 2010. And then everybody got covered in 2017 from April of 17, but that was secondary transfers. And then in 2012 is when, the main primary transfers or primary infusions. So in an M&A world, there are two types of, or in an investment scenario, there are two types. You either buy secondary shares or you have primary infusion done. Secondary was covered earlier, but primary got covered in 2012 from an overall perspective. But even before this came into play, there was a very interesting decision that came across because of a case that a foreign company put money into its Indian subsidiary through a rights issue at less than the fair value. And the tax office wanted to tax that differential between fair value and the amount put in as an income of the Indian company. And then, that was the Vodafone subsidiary. And then the Bombay High Court. And thereafter, they also went to Shell and did the same similar treatment. But the Bombay High Court overruled, saying that there's no question of any premium taxation arising in 2014. And luckily, the government took a call not to litigate further after the High Court. So then, it became a sort of a rested controversy, if one can put it this way. But that was somewhere, some of those things started with this controversy, and that's why the premium was brought above the fair value, because it was inconceivable, basically, to say that something not being received is being treated as an income. And therefore, they brought in this. So just to give a little bit of the legislative history as to where some of these things, could have germinated from. But I think looking at, the issues and especially the startup issues, and, our country is, flourished with a lot of startups. When anybody who's dealt with a startup here, and, again, sir comes from the same land where most startups are there, than we have here in Mumbai. But I think if you look at startups for, say, they are in fact struggling even to know whether they will make money. Okay, they don't know where the revenue is going to come when they are, initially getting into it. They don't know whether their product or whether, the entire thought process is going to be commercializable or not. However, there are people who are willing to bet on those because it's a high risk, high reward game. And therefore, there is, a sort of a valuation which is done to say that this is potentially the value of the company. Now, one doesn't know whether that will be realized or not. So, basis that valuation, we had monies being put into. Now, till the recent budget, if you are a resident, then you have to be very careful that it is being put at fair market value. If you are non-resident, there was no problem. And it used to be very difficult to say that if I raise money from non-resident as well as resident at the same price, then can you say that it is not at fair market value? I mean, because what happens is that from a foreign exchange regulation perspective, FEMA perspective, there is a base price that is available, which is, above which you can always invest. You can't invest below that base price, which is the fair market value. So many cases, people used to invest above that fair market. But if you had done the same for a resident at the same time, the resident portion of the premium used to get taxed. But the non-resident used to, it's still the fair value. A third party who's not linked to us is giving me that value, irrespective of whatever a valuation throws up. Isn't that a fair value? Isn't there a way to look at it? But it was always ignored. And more so, what happened is the controversies around valuation just kept on increasing, in the angel tax. It's never at the time when you invest the money. It's always after 2 years that you start getting the notices or when the assessment starts. And that is a very important element, because if you look at secondary transfers, which I spoke about, there are certain exemptions that are carved out, but there are no exemptions for primary infusion. So let's say if a wholly owned subsidiary is getting money from its parent, a secondary transfer is not concerned. If you get shares on a merger or a demerger, which is, an eligible merger demerger, there is no issue in terms of the secondary transfer or the 56(2)(10). But there is no such exemption in 56(2)(7)(b). So we need to be extremely careful when it is about, 56(2)(7)(b) versus at least there are leeways under 56(2)(10). But coming back to the litigation again, as I said, because there are no leeways,
under 56 to 7B, there are certain tribunal decisions to our help primarily. And one of them is, what happened in a situation which is the Vani Estates decision, basically the Chennai tribunal. It was a company where all relatives were shareholder. And one of the relative put in money at a higher premium than the fair market value. And the tribunal has taken a position that because they were all relatives, nobody has benefited, this should not be subject to tax under 50. Now, company is different, from the relatives. I mean, I can understand this proposition for 56 to 10, but it has also been applied to 56 to 70. So in a way, there is a judicial exception that is being counted. Obviously, it's a tribunal decision, will be further subject to litigation. Similarly, when I look at the Delhi bench of the tribunal, in two recent decisions, one of KBC India and one of PLP Vaya, they have said that if a parent company who puts money into a wholly owned subsidiary, they put in money at more than fair value, that also should not be subject to tax. So the 56 to 10 types of exceptions or, guardrails, are coming into play even for 56 to 7B from a judicial precedent perspective. And these are something that can be helpful to us in terms of the defense if tomorrow, our clients are caught in these situations. I think, and that's very important for us to, be aware about. But the larger controversy is as to when is the taxation under 56 to 7B. So the section came into play in 2012. In a situation, the share application money was received before that, before the section was enacted. Allotment happened after that section was enacted. So what can one say? What does one do in such a situation? Because if you see 7B talks of receipt. Now, receipt was always earlier in this case because the application money was received earlier. But however, the Chennai tribunal again in this case, the Delhi tribunal in this case has said that it is only the year of allotment that we have to look at, whether 56 to 7B has been, complied with or not complied with. And therefore, they said the constructive receipt concept came into play in the year of allotment. So again, we need to be very careful. So because what happens is many times in all this, angel investment scenarios or startup scenarios, there is a convertible instrument that is given at the start, which converts into X number of shares or Y number of shares, depending on, what are the performance criteria. You may give that instrument as a, let's say, optionally convertible debenture or a compulsory convertible debenture. When a debenture is given, at that time, 56 to 7B doesn't come into play. But actually, when you get the shares, on that conversion is the year when you need to see whether you have complied, whether the premium taken is more or the premium taken is equal to fair value. And that is very important, is what is laid out by this decision. Because, year of allotment is how the judgments are going. There is one more case where the shares were issued, but partly paid shares were issued. And the calls were received later, in the later years. And, the department tried to tax the calls received, saying that this is excess and because the value may have dropped of the company, the money received is excess. And they say, no, year of allotment is what I will see. I will not see anything else. And everything else is like a constructive receipt. I have received it in that year, or I was supposed to receive it. So it accrues to me, but it is only getting paid at a later date because when the calls are made. So every time there is an allotment, and mind you, this can be twice also applied. So if you have a convert preference shares, then at the time of the issue of preference shares, you have to see 56 to 7B. Then when an equity is issued against that convert preference shares, you'll have to again see 56 to 7B compliance. So I think it needs to be carefully planned, because each stage, how do I fall within the realms of this? And as I said, the controversies have been primarily on valuation, and in the valuation, the method of valuation. But I think consistently, the courts have held that it is impermissible to change a method of valuation adopted by the taxpayer. So I think to that extent, we'll still have controversy, but it is still a much better proposition because we have more precedents available to us to defend ourselves. The second was, valuation. Let's say today you have to put in money, right? You will do today's valuation. Now, 3 years down the line or 2 years down the line, when the assessment is happening, let's say DCF methodology is used, you have predicted a certain, income stream, you have predicted a certain cash flow. Things may be different. I mean, and just look at it, if somebody had invested in January of 2020 or December of 2019 and then predicted a certain cash flow with COVID, those things would have changed drastically. And 2 years later, when the tax office is looking at, that same investment, let's say it is a resident investment because non-resident was not covered at that time. Can they come back and, tell us, oh, what is all this? Because they have the benefit of hindsight, as I say. I mean, the valuer did not have that benefit of hindsight. The COVID will come, it will impact every business. This is the type of impact, some more, some less. Nobody could, even ever think about it. Right? Because if you look at even stock market prices, they fell like anything, right? So, I mean, so there are several tribunal decisions, whether you take Jaipur, whether you take Delhi, whether you take Mumbai, Kolkata, Bangalore, which they said that hindsight approach is not possible. The value has to be on the valuation date, which is taken by the valuer. Now, actual performance can either be more, could be less. It doesn't matter. Because, it's difficult to say what is going to be the actual value, 2 years later of this company when I've invested. I've invested with a certain, frame of mind, with a certain fact pattern available to me, and that's what should be accepted. So again, a good basis for us to, put that down from an overall perspective. Lastly, I want to just talk on this new 2023 amendment very quickly. Again, obviously, they have carved out certain exceptions. Startup companies are out, but you need to be a notified startup company. So very less of the startups will go out of that bracket. They have carved out certain entities, including FPIs from 21 countries. But, the countries like Singapore, Mauritius, Netherlands, all of them have not in the exempt list. Plus, genuine operating company, let's say US, UK, Australia, are in the list. But a genuine company, which is not like attached to a government entity or a bank, still this rule applies to them. The only good thing is to the notifications. They have enhanced the methodology. So it was not only DCF and NAV, adjusted NAV, but now you can adopt more methodologies, which is akin to what is there under the FEMA valuation. Because otherwise there was a big dichotomy. FEMA said internationally accepted valuation principles. And our laws had only DCF and NAV when the budget came in. Obviously, they have made the amendment, and to that extent, it will help to align the valuations. Otherwise, this itself is going to create a controversy. Now, please look at what is the downside of this, right? We are a country which is what we call import oriented in terms of investment. What did our FEMA did? They did a fantastic job, right? If you are a resident, you are taking money from any non-resident, it cannot be lower than the fair market value. Minimum is fair market value, but you can take higher. Now, when I want to take higher, there is this tax. I'm hitting myself, to get that 25% extra, I'm losing, 100 of investment coming into the country. So to my mind, this is counterproductive. Frankly, if I were to look at it from an overall perspective, but that is what it is today. And therefore, one needs to be very careful even now. So the only exception that has been carved out, which I think can work in certain industries, is when a venture capital company, because it has very few industries that it can cover, like infrastructure, for example, is putting money at a value higher than the fair value. And if somebody else is also putting at the same price, then 56 to 70 will not. So they're allowing that matching, investment amount to be made so that 56 to 70 will not apply. But, we are cutting ourselves from getting more foreign investments and therefore more direct investments coming into the play, because we have given exceptions for FPI, which will only go into the stock market. But we have cut the foot for FDI, from an overall perspective, in terms of getting, a better price for our own corporates, in that sense. Because if I look at, let's say the early 2020s when, almost $20 billion were raised by just one group in the country, Reliance, on its retail and geo platform. Most of those deals were at far higher value than the fair market value. as prescribed under the FEMA valuations. Now they will not have that ability because they have to pay 25% tax on the excess. So it's in a self counterproductive, from a perspective that we have, because more investments you get, the more better the dollar rupee balance will be, also. And I think those are the things that we also need to look at, but somehow the government feels this is much better at this stage. And that's, I think, something that we'll have to live with.
Right. Very interesting perspective. Mr. Chaitanya, I'm sure you will have some take on the fundamental income point, and I'll let you come in a minute's time. Amrish bhai, just staying on the point that you mentioned on the convertibles. Uh, you agree on conversion into, say, equity at a particular stage, say after 3 years or 5 years. You're right that there's a sort of very legalistic way to see when the allotment happened, but commercially parties are agreeing today, right? When, how I'm going to convert. So how do you reconcile the commercial reality and this hyper-technical requirement under the law?
You see, unfortunately, the decisions are also saying that you need to look at the time of allotment. So as recent as the Calcutta Tribunal in the Milk Mantra case in 2022 has also come out with the same, basis. I think if you look at again FEMA, you are allowed the conversion at the prime of your entry point, which is whatever is the value, or at the time of conversion, whichever is higher. So in a way, it addresses one situation. However, income tax will only look at the first time. Let's say if you have given a convertible, instrument, it will not look at that time. It will look at the time. Let's say debenture is given, it will only look at the time of the conversion into shares, because allotment of shares is happening at that time. Now, generally, the principle is that the price should have gone up, because that's why I invest in a company. There will be food situations where, somebody has failed, or the cycle when the conversion is likely to happen is not the right cycle. And there will be a lot of challenges which will come up, but that we will know maybe from 5 to 7 years from now, because those assessment will happen. Let's say if it is 3 years after 2 more years, and plus 5 years after 2. I hope, they will listen to cooperating in some of those things. And at least align, if nothing else, they need to align it with the FEMA valuation rules, because they have been there for quite some time. And in cases of non-resident, and I would say even for resident, because why should you distinguish between a resident and a non-resident investment? I mean, there's no basis, to distinguish that. So to my mind, I think it should get aligned by that time. They will see good reason. They may have some good basis for doing it now, but at least I think, over a period of time, they will realize some of the nuances. And at least if you see the 2 notifications that have come, I think post, enactment of this particular non-resident aspect seems to be suggested to be a progressive way of looking at it. At least hearing, what is the practical difficulties, and then trying to address to the extent the best that they can.
Right. Mr. Chaitanya, any dimension of income in angel tax, income or non-income?
I would answer your question by taking forward from what Mr. Amrish said about the conversion. See, when the debenture is issued, 5627B doesn't trigger. When this debenture gets converted, certain tribunal benches have taken a position that there's a constructive receipt of consideration. In my view, with due respect to those tribunal decisions, this may not be the right approach for 2 reasons. I am mindful of the Supreme Court decision in JB Boda 223 ITR 271 about the constructive receipt. However, if you look at 5627B, what triggers this tax is receipt of a consideration. If there is no receipt of a consideration, 5627B should not trigger. This is a jurisdictional fact. If you look at the decision of Supreme Court in Arun Kumar case in 286 ITR 89, if you're able to establish the absence of a jurisdictional fact in a particular provision, the tax should pay. Now, you may ask me a question. Last year, when the debenture is issued, the company writes as debenture in its balance sheet. Today, what it does, in the current year, when it converts, it rewrites it as share. So is there a constructive receipt of consideration? The answer is no, for the reason that all these are the agreed terms of a particular arrangement, which arrangement took place at the time when the jurisdictional fact did not exist. So therefore, mere conversion of debenture into share at a predetermined rate upon the basis of terms that were agreed before would only be completing a transaction, and it should not amount to even constructive receipt of consideration. And for this reason, unless a mischief is played, whereby they could use GAR if they want to, according to me, these tribunal decisions may have to be most kindly reviewed. This is point number one. Point number two, another important aspect that has to be kept in mind is that this 5627B is a testimony of failure of income tax department to catch you under 68. See, under 68, they will have to catch you and put you on 115 BB at 60% tax. With surcharge, it will take up to 80%. The trinity of factors, creditworthiness, identity, and genuineness, if established, 68 should not have any place to exist. Now, if the department is fearing that in the name of the so-called premium, unaccounted money is being flooded in, then they have all the weapons available to them under section 68. And if they're successful in 68, don't expect them to take you under 5627B, which will fetch them only 30% tax. They'll fix you under 68. And because they can't fix you under 68, now they're going to tell you, you have a fantastic idea, don't sell it too well. So it's like you have a fantastic idea, don't sell it too well to the investors. If you sell it too well to the investors, they'll be investing much more money, which will mean you having to pay angel tax. What kind of a tax life do we lead here? Is this the way a growing economy like ours, where we would need loads and loads of funds, behave? So it's not an angel tax, it is rather a Satan tax. So it's a misnomer to call it as an angel tax. Look at another fraud that is played on the taxpayers here. You have the valuation rules. Mr. Amrish may correct me if I've gone wrong here. You have the valuation rules. You have 11 UA, UAEB, or whatever, all these rules. You have 56.210, which, Ameya is going to ask me some questions a little later on. And you have 56.27B, which Mr. Amrish is now discussing. Look at the dichotomy in the valuation they've adopted there. So when it comes to 56.210, they would want the fair market value as high as possible. So things like jewelry, land, etc., would have to be taken at the fair market value or the stamp duty value. Whereas when it comes to the NAV for the purpose of angel tax, do you believe they would take the land at book value? So look at the kind of, a fraud that is played on the taxpayers. So whoever who conceived this in 2012 and whoever who continues with this fantastic idea even in 2023, both will have to be immensely blamed for this kind of a nonsense tax.
Not just continue, expand the scope.
So initially, they used to say, don't sell it too well domestically, sell it fantastically outside. Now they have removed the discrimination between residents and non-residents. So irrespective of where you go to sell your idea, undersell your idea. Otherwise, you are visited with the angel tax.
Right. Again, a brilliant discussion. Thank you, Amrish Bhai. And moving on to the next topic, which Chythanya mentioned about 56.210. We all know that we as a country abolished gift tax many years back. But in a way, we see gift tax or tax on the transactions where there is no adequate consideration are being brought into the ambit of the Income Tax Act through section 56.210. I mean, again, if you see over last 15 years, the scope has been expanded to cover first individuals and now all the SSEs, certain group of assets, and now almost all of assets barring some intangibles and so on. You touched upon the point of receipt. And again, 56.210 hinges upon, first there is a receipt of something which is without adequate consideration. So, Mr. Chythanya, again, first, if you could wear a very, very fundamental hat on, can there be a fetters to, what you can define as an income and any niceties around 56.210 that you observed?
See, it is agreed and accepted that the parliament has the plenary power to tax. They can tax you prospectively, they can tax you retrospectively, if they choose to. They could even have double taxes. The only place where you could challenge whatever tax law enacted by the parliament is on the premise that it offends Article 14. The tax is so high, that it ceases to be a tax. It becomes expropriation, which will mean the parliament wouldn't have power to levy tax because it ceases to be tax. However, the courts have also said that, look, parliament will have to manage a large economy. It has a lot of latitude. So as compared to other laws, when it comes to tax laws, we will presume the constitutionality of the provision rather than the otherwise of it. So onus is on those of us who challenge. Now here is a case where they have brought in 56-10. It started off in the form of 56-5, became 6, became 7, 7A, and now it remains as 56-7B and 56-10. This again is a mischief provision, which in fact they issued a circular just before when National Herald case was being argued in Delhi High Court in the context of 56-7A. They issued a circular saying that it's an anti-abuse provision. Unless the abuse is established, it wouldn't be pressed into service. It would not apply to allotment of shares. The circular, I guess, was issued on, I think, Thursday or so. The matter was argued that day. There is a disconnect between these two, but somehow the arguments reached the income tax department, and within 3 days, they issued another circular retreating it. But the mischief here is that in the name of gifts, are you laundering your money? The gifts are tolerated because they're capital receipts, and as they remain genuine, shouldn't be taxed. But in the name of gifts, we launder money, get our own money back, which was hitherto untaxed, call it as gifts and color it as white. And that is when, the law steps in to regard earlier as taxable gift and now as income. So this is akin to donee-based tax, where in the hands of the recipient, it is charged to tax. Now, this is one type of income, very strangely, which is very similar to your, 224E, where this is an income incapable of accrual or arisal. What is accrual or arisal? Is something where you have a right to receive, where you can demand as a matter of right, a legal right. What kind of legal right do you have on gifts? If it is given to you, take it happily, otherwise you can't question it. Right. So this is a case of something that becomes an income after you receive it. So till it reaches your hand, it wouldn't even have become an income. So upon receipt, it becomes an income. So this is a very, very, unique case of upon receipt, something becomes an income. And the legality of this as such may not be open to any great challenge. You just have to live with this kind of a provision. And only thing what you have to do is plan in such a manner where you don't get caught here. And if you're caught, then push to wall, then take all the defenses available. Very, very similar approach will have to be very similar to the earlier two provisions which were discussed. Now, if you look at 56-10, it is applicable to all types of persons. Unlike earlier where it would have applied only to individual and HUF, 56-7 era, or 56-7A, which then would have applied only to the firms or the unlisted companies. Whereas now 56-210 would apply to all, even listed companies would get hit. Whatever be your tax personality, you are hit by 56-7. Post 1/4/2017. So you'll have to be extremely careful here. And you also will have to be aware where you could get hit by this provision unaware. Take some situations where you're taken a loan is waived. You've taken a loan, loan is waived. Are you hit by this? Is there a receipt of cash? See, in our innocent thinking, the waiver of loan is not receipt of cash. However, there is a decision of Supreme Court in Mahindra and 404 ITR page 1 in the context of 28.4, where the Supreme Court said that the waiver of loan would tantamount to receipt of cash, and therefore 28.4 would not apply. What is 28.4 as it then existed? Any perquisite or benefit arising from the business or exercise of the profession would be deemed to be a profits and gains of business or profession under 28.4. Now they were amended in 2023 to say that even if you would, receive whether in cash or otherwise, it would nonetheless be hit. So 28.4 is now made applicable. So now if you have taken a loan, a business loan, if you are carrying on business or profession, a loan is taken. If that loan is waived, then possibly you could get hit under 28.4. If you've taken a personal loan and if the loan is waived for whatever reason, you could get hit under 56.210. Now, if somebody applies Mahindra and Mahindra ratio here. Now, before we get into other nicer aspects here, just the broad, proposition of law here, there are three types of, receipts which are covered under 56.210. One is receipt of a sum of money, but the aggregate would exceed 50,000 rupees. Two, receipt of an immovable property, either without consideration or for a consideration which is less than the stamp duty value, where the difference, the delta, exceeds higher of the two, 50,000 rupees or 10% bandwidth, which is provided. Then you will have to pay the tax. Thirdly, a movable property. The movable property, if you would receive either without consideration, where the fair market value would exceed 50,000 rupees, or you get it for a consideration and consideration falls short of fair market value by more than 50,000 rupees. In these situations, you will have to pay the tax. As I said earlier, it applies to anyone who would receive it. But then the subject matter of receipt will have to be either a sum of money or will have to be an immovable property, being land, building, or both, or will have to be a movable property. Now, sum of money, you could have a lot of doubts here, whether what is the sum of money? A medium of exchange is called money. Whether receipt of forex will get caught here is a question which will have to be understood. Whether, a question that arose, when you get crypto, will it get hit as a sum of money? We all said crypto is not money. Then they amended 2022 Finance Act amends the property has to include even VDA. So virtual digital asset is also called as property, which means it is not otherwise a sum of money. If in the understanding now, when it comes to immovable property, they say land, building, or both. They don't say just immovable property. They say immovable property being land, building, or both. Now, we deal with situations which would go much beyond land, building, or both. It could be rights in land, leasehold rights, easement rights, and so many, rights attached to land, which at times under different distinct laws could be called as immovable property, but it would fall short of being called as land simpliciter, building simpliciter, or land and building simpliciter. And therefore, a question that would arise is, if you were to get interested in immovable property, would you get hit by 56.210? If you look at different decisions of different courts, one Karnataka High Court in the context of 50C, Chandrasekhar's decision yet to be reported, has said that 50C, which uses identical language, land, building, or both, interest in land is not covered. Now, taking clue from that, it's possible for us to argue that the interest in land like leaseholds, etc., should not get caught under 56.210. Third, what a property is. Third, the movable property. Here, the property is not something which is, inclusive. It is exhaustive. whatever they defined alone could become property, not anything and everything. They had an exhaustive list of items, and if and only when you would get it, it would become a property. So what are the properties? It could be shares and securities. What is security? Security is not defined, nor a reference is made to Section 2H of the Securities Contract Act. But then the courts, the jurisprudence suggests that if a term is used nomen juris elsewhere, it could as well be used here. So no wonder if the courts would apply the definition of security as is given in Securities Exchange Act, where if you look at the meaning of security under SEC, it would include, all these collective investments, even your units of business trust possibly could be called as securities there. The mutual fund units could be called as securities. So all those could fall within the meaning of security so as to get caught under 56(2)(10). Shares and securities, your jewelry, then you will have bullion. Now, is gold coin a jewelry? The answer is no. It wouldn't fall within the meaning of jewelry. Is gold coin a bullion? What is bullion? Bullion is, like uncoined mass of gold is bullion. So if something is coined, it's neither jewelry nor bullion, and hence can you play around with that? The moment you start playing around too much with it, you would assure yourself that there's going to be an amendment imminently next year. So play it safe and be careful about it. Don't go too aggressively about it. And you will have then the work of art. You will have the archaeological collections, paintings, drawings, sculptors, etc. are also now regarded as property. But if you plan to give me a very expensive car, it is not a property. So not covered here. And therefore, I do not have to pay tax in respect thereof. So there are still a lot more assets which would not fall within the meaning of this and which would not get hit by 56(2)(10). Then there is a big list of exemptions. So you also will have to wonder many a times, can you play around with these exemptions? Again, it depends. So you will have on the occasion of the marriage of the individual. They have never said on the occasion of the marriage of the assessee. They said on the occasion of the marriage of the individual. So my daughter is getting married. You all give me gifts on the occasion of the marriage of the individual, not the assessee. So just one way of, and if it is a marriage gift, should it be on the occasion of the marriage right at that time? Could it be a little before this or thereafter? If thereafter, how far after? These are all the issues which will, arise. And you will have then the property, money, etc., received from or by a trust registered under 12AB. Look at this. From or by. So this is where you would have seen some decisions which have said that the cricketers who have paid the benefit match, like proceeds, the courts have said they're not liable to pay tax because they got it from the local cricket associations who would have, for whatever reasons, registered themselves as charitable trusts. Right? So you will have registered yourself as charitable trust, and if as the next player I get the benefit match proceeds, then the courts have said I'm not liable to pay tax. So whatever money you get from a charitable trust which is registered, irrespective whether the charitable trust will qualify for exemption or not, despite it being registered, as you would know, it may not qualify for exemption. So you have the Auda decision, Supreme Court in the, like 341 ITR 1 about the general public utility GPU category, how has the court dealt with that? So irrespective of whether the trust gets the benefit or not, you would get the exemption. Now look at another, like a flaw in the drafting. They've said even received by a charitable trust registered would also be exempt in the hands of the recipient charitable trust. So would that mean that the voluntary contributions which a charitable trust would receive, which would otherwise be income under Section 12, which will get exempt only if you adhere to conditions of Section 11, will be automatically exempt under 56(2)(10) because there's a specific exemption whereby you don't have to adhere to the conditions at all. So look at, the kind of mischief that could be played by mere use of word by a charitable trust. So any receipt by a charitable trust, if it were to be exempt here, why on earth I would undergo the hassle of Section 11, 12, etc. I would as well claim the exemption here. Now, these apart, then we'll have a list of relatives. If you get it from a relative, it would be exempt. Now, they have a list of relatives which is longer than the list you have under Section 241. So you'll have to be careful about, the type of relatives. It is not two-way traffic. For example, when you get it from an uncle, it could be exempt. When the uncle gets it from nephew, it may not be exempt. So these are some final aspects which have to be borne in mind. Then there are other ways where you could get caught, or questions would arise. Take a case of a partner. And before I go to partnership, one another thing. You also have to be aware of one provision called Section 918. Section 918 says where a resident pays a sum of money to a non-resident outside India, income arising therefrom will be charged to tax. Look at this. You are a resident, I am non-resident. You would give me money outside India. If you would give me money within India, there is a receipt that takes place within India. I will have to pay tax. You give the money to me outside India. They seek to tax that. But have they properly made provision in this regard? The answer is no. The language used in 918 is that income arising. How does income arise here? There is no question of arising of income. Arising and accrual for income will have to be understood as same, is what the Supreme Court in E.D. Sassoon has said in 26 ITR 27. So there is no question of arising of income. So therefore, even if you would give me the gift outside, it's possible for me to take a position that as a non-resident, I've received it outside India. It would not come within the scheme of Section 5.2, and therefore you cannot tax me. It cannot be caught under 918. Now, interestingly, if you look at even a resident receiving it outside, a resident receives the gift outside, would he be liable to pay tax? Not for planning again, only for defense. See, if you look at Section 5.1, it would only deal with income received or deemed to be received in India on his behalf during the previous year, or income that accrues or arises to him in India. 5AC, income that accrues or arises outside India. There is no utterance about the income received outside India. This is one income that is capable of being received outside India without being preceded by accrual. And therefore, on a very aggressive note, it's possible for you to argue that this is an income that never accrues. It can only be received, and I've received it outside and hence not to be charged to tax. All these tips as lawyer I'm giving because you would escalate and come to me in the lighter vein. Now, that apart, you have time, couple of minutes. That apart, a question may arise as to when a partner gets it from a firm, or when a firm gets it from a partner, a property, which is otherwise covered under 56(2)(10. Would the recipient be liable to pay tax? You have Section 45(4), you have Section 9(B), and you have the decision of Justice Amrish Shah and Mansuklal dying, on which several seminars would have already been held, which will make the firm liable to tax. The firm anyway pays tax, whenever it gives away a capital asset, it gives away cash on the occasion of change in constitution under 45(4), or whenever there is a dissolution, it gives away, the cash or the capital asset, or whenever there's a change in the constitution under Section 9B, you give away stock in trade or a capital asset, you get taxed as a firm. That's okay as far as firm is concerned. What about a partner who gets it? So is a partner liable under 56(2)(10)? Now, when a partner gets an asset, whenever there is a retirement or on dissolution or whatever, the courts have held that what he gets is not to be understood as without consideration. What a partner gets is what he otherwise jointly owned. As a matter of his right, partnership right will enure him that. So he gets it accordingly. You can refer to 165 ITR 166, Mohan Bhai Pamabai case, and a host of other decisions which have come thereafter. Till such time, a disturbing note was set by Mansuklal dying's case. Now, when a partner gets something, he gives away something. What he gives away, there could be a debit in the capital account. A share of him in the partnership could get reduced. So it cannot be said without consideration. There is a consideration. And the consideration here will have to be understood not in income tax sense, but will have to be understood in the context of Section 2D of the Indian Contract Act. Tata Yodogawa, Jharkhand High Court decision. has very clearly held that for the purpose of 56(2)(10), consideration at Indian Contract Act. What is 2D? If I do something, abstain from doing something, if I promise to do something or promise to abstain from doing something, such act or abstinence, or promise to do or abstain, would itself will constitute a consideration. Is what the meaning of consideration is. So the consideration which a partner gives away is something which is not to be, it exists, but you cannot ascertain it. When you cannot ascertain, how do you compare? You cannot compare, because whatever you get will have to be compared with the consideration. And you have to see if a delta exists. The two figures will have to pre-exist for the purpose of comparison. If the two figures do not exist, taxation fails. PNB Finance case, 307 ITR, page 75. Two figures will have to exist for the purpose of comparison. So now, likewise, when a partnership firm gets an asset from a partner, the Supreme Court in Sunil Bhai Siddhartha Bhai's case, Sunil Bhai Siddhartha Bhai's case in 156 ITR 509 has held that the credit to the partner's capital account is not the consideration. The partnership right, what he gets is the consideration, for which, like you are receiving a property. So you get a property. What is the outgoing consideration? Giving away the partnership right to him, value of which is unascertainable, indeterminate. And we don't have a provision similar to section 50 capital D. And therefore, comparison fails and the taxation fails. Take the case of 4713B, where you will have, like a company becoming an LLP. If you have to satisfy some conditions, what if you don't satisfy those conditions? Then 4713B would not apply to you, and therefore you will have to pay tax. Then the emerging LLP, will it be liable to pay tax on the assets that will get? The answer will have to be no, for the reason that he gets those assets for giving away the partnership interest to the partner. What is partnership interest to the partner? Not the amount credited to the capital account. His ability to conduct the business of the firm, his ability to have mutual agency, his ability to demand a share in the profit and the accounts, and his ability under section 45 of the Partnership Act to get the dividend in the event of dissolution of the partnership. All these together would constitute his partnership right, which cannot be ascertained till such time the event of dissolution takes place, is what the Supreme Court has held. And therefore, the taxation should fail when the firm gets it. So these are some of subject to availability of more time. We could bring on more such instances about, the 56(2)(10) applicability.
Yeah. A lot of questions are also flowing to my mind, but I'm sort of conscious of the time. We'll come back to some of these points, Mr. Chythanya, and maybe later, hopefully, if you could try and address land held as stock in trade and it is transferred under 56(2)(10), what happens? But I'll sort of move on to Amrish Bhai, and we've been discussing tax losses, and you all are aware that business tax losses can be carried forward for a period of 8 years, and through a merger or a demerger, these losses can flow through into the target entity or into the new entity. But it comes with a lot of riders. There are different types of losses: business loss, depreciation, capital loss. Amrish Bhai, your take on what happens to these losses and the nuances around it that you've seen in several transactions that you worked on, Amrish Bhai?
Yeah, so I think this is a very interesting topic by itself, frankly, if you ask me. But if you see the evolution of how this came into play, I think when this was enacted, it was only meant for sick industrial companies. I mean, initially, because the idea there was that you are trying to revive a sick company, and therefore employment, therefore business, and therefore you should get this benefit. But over a period of time, it got extended to all the amalgamation provisions got extended to all undertakings. And then later on, some service sectors also got covered, like telecom, software, hotel business to some extent. But very, very, again, limited coverage. It's not like a free flow for every sector to be covered from an amalgamation perspective. The good point of an amalgamation is that if you qualify and you are satisfying those three conditions that are laid out under 2(1)(b), which means that all assets are getting transferred, all liabilities is getting transferred, and 75% of the shareholders are becoming shareholders of the merged entity, except for whatever is the cross holding that is there. then this losses and even unabsorbed depreciation is allowed for you to be carried forward, and the losses get a fresh life of 8 years. So, if you are towards the end of your period of 8 years for the carry forward losses, and you can think of a commercial rationale to merge, then you get another 8 years from the date of that merger. So that's, I think, the best part. But there are a lot of riders. You need to carry on the business for 5 years. You need to also carry on the asset base, at least 75% of the asset base for 5 years. You can't dispose of that asset base. You need to preconditions of, at least having 75% of the assets, which were 2 years before the amalgamation, being available on the amalgamation date. So there are a lot of those conditions, and the most difficult one, which I've seen is, the 50% utilization in the 4th year of the amalgamation, after the amalgamation, because they are saying that you are going to be, at least 50% of your capacity you are going to produce even in the 5th year. So the business that is merging, that 50% capacity has to be done in the 5th year. Even if you are not able to do in the first 4 years, it is okay. But the 4th to 5th year is where you need to do it. And, I had a very particular situation here. So we were a company which was producing water. The factory was very close to a water flow. And over the 5 years, due to whatever climate or any other reason, the water flow had stopped. And we were not able to do the, 5th year capacity utilization. Now it's a natural event, right? It's nothing that, I control. We actually had to go to CBDT under 119 to seek a particular waiver, of that clause because of this natural event. But that, who keeps a track at the end of the 5th year, right? The amalgamation is done, let's say in 2020, when you are filing your return for the, year March 25. I mean, very difficult to keep that type of a track from an overall perspective. And that becomes very, very important, when you look at carry forward of losses, and it's very important. But are there other situations where the losses can pass? So, we have a very old Privy Council decision in the case of Indian Iron and Steel 1943, which says that if there was a business transfer, then a loss cannot get transferred. Basically, it was also followed obviously in 2014 in the Rajasthan Rajya Sahkari case, in case of a cooperative, that accumulated profits can also not get transferred on amalgamation because that's not provided at that point of time. Now there is that, section on cooperatives also, societies also being, cooperative companies also being included. But issue is that one needs to plan them very, very carefully. The question that keeps on coming is, what happens to capital loss? Is it transferable on merger? Is it not transferable on merger? Because if one reads section 72A, it only talks of business loss and it talks of unabsorbed depreciation. It doesn't talk of capital loss. So if it is not specifically provided that you are eligible to, get that benefit, can you get that benefit? And I think the general consensus among all of us is that it is not available, it lapses. I mean, that's the general consensus. But, the Pune bench of the tribunal in Capgemini's case has given a favorable decision. So there is, at least in a defense situation, there is some decision that we can rely ourselves on, to fight for whatever it is worth in case, there is a capital loss situation that is there for the merging entity. Because that could help us, from an overall. And I think it is based similarly to what the Supreme Court, laid out in the Veerbhadra Rao's case for bad debts, availability in the merged entity. I think it is very, very similarly, created. What happens to MAT credit? Now, there is no provision which specifically provides that if the merging entity had MAT credit available, can you take it into the new entity? If that is also still paying taxes on a MAT basis and not, applying the new provisions of 25% tax. Again, no provision. But there are two decisions, one tribunal and one high court. So the Neela infrastructure of the Gujarat High Court and the Skol breweries of the Mumbai Tribunal have said that, MAT credit can be transferred. But one planning there is that if you want to transfer your MAT credit, at least provide it in your scheme of amalgamation. Don't let it happen just, outside of that, because at least then there is an additional thing that was also taken over by the merged entity. rather than, leaving it to open for, somebody to interpret that whether it was taken over or not taken over. So generally the advice is that irrespective of whether you are under MAT or not, add that in your, assets taken over, because if we have to write the assets taken over, we have to write the liabilities taken over and the employees taken over in a scheme of amalgamation. So please always ensure that MAT credit is one of the things that you are taking over, irrespective of whether it is there or not. If it is not there, that doesn't matter any which way. But if it is there, then at least you can rely on this decisions if you want to take, benefit of that MAT credit. So I think a lot of things have, been hovering around some of these decisions, but assume you are not able to satisfy those conditions which are laid out in the amalgamation. Then there is a very interesting case, which to my mind has not gone further beyond the Bombay High Court, which is in the Hindustan Petroleum case 187 ITR 1. So what happened in that case was the merging entity had unabsorbed depreciation. When the merger took place, they did not go under section 72A to claim the benefit under 72A. They said my starting point of depreciation or WDV is whatever has not been, whatever is WDV plus the unabsorbed depreciation. And therefore they added it to the WDV when they took it over into the merged entity. That went into litigation, obviously, and Bombay High Court ruled in favor that whatever is the unabsorbed depreciation of the merging entity, or the amalgamating company, that has to be added to the WDV for purpose of determining what is the combined WDV of the merged entity. So if you are not able to satisfy those conditions, at least depreciation can be saved because of this decision. So that is very, very important. Again, in many cases, if you are looking at, a merger or a demerger, let's say part of the year. So you don't start a merger with an appointed date of April 1, of a year, but let's say you take, just as an example, July 1. For whatever be the good commercial reasons, and sometimes there are good commercial reasons. The first year depreciation becomes very important as to how you will get it. More important in a demerger case than a merger case, because it says that whatever was the WDV of the previous this thing will be available on a split basis on the number of days. But thereafter, again, you can go and claim. So if I apply this Bombay High Court decision of, the unabsorbed depreciation, I can't add that completely to the WDV in the first year, because I will only get the WDV of the merging company. But second year onwards, I can add it. So I need to be very careful when I'm planning this. And, this was also laid out in the Karnataka High Court decision of United Breweries, where you can't get anything as a beneficial, addition. When, you're looking at a tax neutral way of, merging or demerging a company. So one has to plan this very carefully. Even in business transfers, when you do it at fair market value, you will not get the depreciation in the first year on the basis of the purchase price allocation that we generally do, because you will only get basis the tax WDV of the transfer or entity in the first year, and again on the basis of split if it is done in between the year. But second year onwards, the way you have to do is your PPA is so much minus your first year depreciation, which will be a smaller amount based on a very different calculation. And then whatever is the balance WDV, you take it on as if it is a business as usual, way of calculating depreciation. So I think these nuances need to be factored in, because of the several decisions that have come into place from our perspective, because unless we are able to, take this, I think, we might not get the real benefit that one is looking at, when we are thinking of such type of restructuring from an overall perspective.
Amrish bhai, a quick follow-on question. I mean, losses, can happen in any business, even in a service sector business. And again, I'm using the word startup in a loose way, not the DIPP approved startup, etc. But the new age companies do end up having losses. If we see the definition wherein the merger happens, only a qualified industrial undertaking is covered over there. And that again has a very, very narrow prescriptive definition. So any thought where what happens to the businesses which are going into the merger, but where those businesses are not covered with the 72A industrial undertaking definition? Any thoughts on that?
So generally, I think, what one sees in those situations, and there are several such similar examples, is people look at demerger versus a merger. Obviously, we need to be very careful now because of the GAR provisions. That did I do a demerger only to claim the tax loss benefit carry forward versus a merger, which was the real intention. But a demerger does not have any such condition. It is available across the board for all types of companies. It doesn't have any pre and post condition. The only downside of a demerger versus a merger is that the loss carry forward period doesn't get a fresh life. So if you are in the 4th year, you only get 4 more years in a demerger, versus in a merger, you would have got 4 plus 8, which would have been 12 years. So there is some pluses, some minuses, but if you are able to do a demerger with all the good commercial rationale around it, then potentially even those companies can likely benefit from an overall, loss carry forward.
Right. Thank you, Amrish bhai. Very interesting perspective. The clock shows exactly 5 p.m. And we are at the end of the planned agenda, but we can extend for 5-10 minutes and take the questions from the audience on the 4 topics that we discussed over here. I think people are raising hands. Do we have a mic to circulate, or else you'll have to speak louder? If you could be brief with your question, that'd be wonderful. Thank you. Please, sir.
In case of redevelopment of property, you surrender your existing flat. In lieu of that, you get an additional flat, but you tend to get some additional area free of cost. In such a scenario, the document, when registered with the stamp duty, attracts some stamp duty, which is not a consideration received by the recipient. I mean, the guy who has surrendered the flat. In such a situation, whether 5627B gets attracted, because of late department has started issuing notices where 5627B has been invoked and they have made additions.
In the case of the redevelopment, so if I understood the query right, you give away your old flat, correct? In consideration thereof, you would get a new flat plus some cash consideration. Correct? You get additional area. Yeah, you get a new flat also free of cost. In addition to that, you get some additional area. Is it area, built up area? Is it built up area that, see, for example, 2000 square feet flat, you had an old flat of 2000 square feet. Is it that you get a new flat of 2500 square feet? Is that what you meant? Okay, so additional, I thought over and above your flat, you get something else. Okay, you get a bigger flat, correct? See, when you get a bigger flat, when you have surrendered the older flat, right? Now the point for consideration is the whole of the consideration what you get. So it's a case of an exchange of an old flat for a new flat. And George Henderson's principle should apply, 66 ITR 622, Supreme Court decision, where there's an exchange. The incoming value, the value of the incoming asset, the fair market value of the incoming asset will have to be adopted as full value consideration. So now, you have got a bigger flat of 2500 square feet, correct? The incoming value of that will have to be adopted as the full value consideration. That is definitely ascertainable. And that would have become a full value consideration, which will then be the process of computation of capital gains will start. So therefore, having done that, it does not lie in the mouth of the income tax department to say that you got a flat for a consideration, you got a building for a consideration which falls short of the fair market value. See, ultimately, whatever is the fair market value of 2500 square feet is the consideration. So what you have paid is the old flat. So what you have given away is the old flat. That anyway would have been allowed to as a cost. Therefore, it would not be right for the income tax department, having considered that it's part of full value consideration for the purpose of 48, to again bring it to tax as income from other sources under 56(2)(10).
Hello.
Yeah, and just to add,
Hello.
just to add, I think, and thereafter, because of 54, because you are deemed to have invested in the larger flat, right? Because that is what you have got. I think you will go and just claim that in the 48 computation itself, ultimately there will be mostly a nil result. So in a way, because of 48, but the more important thing is at a later stage, because you have claimed this 48 exemption and all, when you want to sell the new flat, you should then take the new fair market value, which has been used for this computation.
Hello.
Here and then here and
Yeah.
then pause. Yes.
One is private limited company, the family enterprises. There is a 3 directors and equally 3 members are there, the shareholder. The company has done one transaction that they are transferring the amount, like that's 2 crore and 2 crore to 2 director in saving account, and they invested in the personal bond, that is the RBI bond. And company have passed the resolution under section 185 as a company act that that asset shown in the company only that the bond, that is an investment, not a loan. Okay, that what is the consequence of section 222E or 185?
If I understood your question rightly, the company funded certain amount, the directors bought out bonds. These bonds are considered as belonging to company, correct? Right? See, irrespective of whether provisions of Companies Act are complied with or not, one thing for sure is that these directors are holding them in trust for the company, because they have used the money of the company to have certain bonds bought, which bonds, there is an addendum that these bonds would belong to the company, and therefore it cannot be called as an advance or a loan given to the directors, and therefore section 2 within brackets 22 within brackets E should not trigger. Yes. Yes, sir.
Yeah, this is on section 220E. Amrish sir, just I want to ask you as a defense, not as a planning. When already corporate has given the loan to the corporate, whether I can show it as a joint venture advance.
So basically, I think what you are saying is it is for some business purpose.
Yeah.
Right. And at least to my recollection, where it is for a business purpose, I think, and it is demonstrable that it is for a business purpose, then it might get out of the 222E net. But you'll have to demonstrate that with your fact pattern in not only one-off transaction like this, but what are you doing on an overall basis?
Yeah, but for that purpose, I have to create any SPV or I can directly special purpose vehicle I have to create, or I can.
No, you could do it directly so long as it is for business.
Okay.
We have run out of the time. Written question. Not what I asked for. Request Mr. Chythanya to address.
Last question. The question is on whether 56 to 10. How does it apply to a real estate held as stock in trade? Because the definition of property excludes stock in trade, but then there's a separate clause dealing with the real estate as a property separately in the main section 56 to 10. So, sir, your thoughts?
There is a drafting lacuna in 56(2)(10). Intention is very clear that as they define the property in explanation to 56(2)(7, even for the purpose of 56(2)(10, they have said property being capital asset and being the following. So the intention, as they introduce those 2 words like capital asset in the explanation, is very clear that the objective is to tax the recipient when he gets it as a capital asset. So where as a recipient, I would get it as a stock in trade, objective is not to tax because I would have got it as a gift, no cost to my business. When I would sell away, the whole of the amount will possibly suffer tax. So the idea is very clear, is to tax it in the hands of the recipient, only if the recipient gets it as capital asset. However, the error occurs in the main body of 56(2)(10, where they should have worded it like how they had worded it 56 to 10C. In 56 to 10B, they have called it as immobile property being land, building, or both. Instead, they should have called it as property being an immobile property. Rather, they have straightaway gone ahead and said immobile property being land, building, or both, which for a while would wonder whether you will have to look at the definition of property at all or not. If you have to look at the definition of the property only, then there is a word of capital asset which is coming there. But there's just a drafting error. I don't think this should create any problem. Definitely at the appellate forum, the court should have larger heart to accept this and give you the relief. But at the assessing officers level, you have experienced it. Anything could happen at any stage.
Thank you. Thank you so much. Thank you to the wonderful audience here who was staying back on Saturday evening. Thank you to Amrish Bhai and to Mr. Chythanya for a wonderful conversation to open out and give various niceties of the law. Thank you so much for your time. Shweta, thank you, and over to you.
So excellent discussion, wonderful moderation, and so many takeaways from this panel discussion. That's all I can say for this panel discussion. So, well, thank you. Thank you so much to all of you for joining us today and sparing your valuable time with us. So we have reached towards the end of this direct tax refresher series, but it can't be end without giving a thanks to so many people who were behind of this DTRC planning, execution, so that we can reach to this at this point of time today. So start with all our speakers. Of course, without their time, without their knowledge, it could not have been possible. A big thanks to our all speakers, then our event management team, all people who are behind of this program, photographer madam, जो चारों दिन हमारे यहाँ एक टांग पे खड़ी रहती है, all the programs. Thank you, madam. And to the venue people, this Yogi Sabhagrah. And last but not least, to thanks to each one of you, because without your participation, it could not have been possible. Thank you. Thank you so much. Keep participating in our WRC program. It gives us some motivation for us. Thank you so much. We have kept snacks out.